So the reason for starting a revision series, okay, all of a sudden, because I have seen the certified copies and the mistakes. So they're doing clerical errors, and next basic conceptual mistakes. For suppose if they are not writing at all, so that is okay, fine, but they are doing a basic conceptual errors and what clerical errors. So that's why. So what is the reason for conceptual mistakes? Basic lack of a conceptual clarity. If you are lacking conceptual clarity, then what? You should go for regular class or else at least exam oriented class if you do not have a time. What do you say, Varsha? Next, for suppose if you are committing a clerical errors, that might be due to lack of a practice, and for that you should attend this Pedaredi OG revision series, and you have to subscribe for what test series. You have to write examinations, number of exams. Okay. Next, increase the sound. Varun, can you please call Bharat? Okay. So first of all, you should know what is the reason why you're getting less marks in SFM. You should know the reasons, and most importantly, next you should take a oath. What is the oath, Varsha? I'm not going to use social media or phone till December. Till December. Okay. Pedaredi, oath. Next schedule. Okay, clear. You should not use mobile until what? December. Then you might be, questioning, sir, how can we watch YouTube classes? So that's why I have mentioned. Okay, at least you should not use what social media, Instagram, Snapchat, etc. Okay. And next schedule, revision series schedule. Day 1, I'm going to discuss portfolio management. Discuss means I will just recall the concepts. I'm not going to explain the concepts, and I will make you practice A++ questions. You know that we have categorized the questions into what? 3. Okay, A plus, and A++. A category means what? Those questions you need not refer. A+ questions you have to refer. A++ questions you have to practice. Compulsory you have to practice. Okay. Next. So day 1 portfolio management, and at the end I'm going to discuss bullet MCQs. Bullet MCQs. So I'm using the last attempt sheet only. Okay. So you need not worry. So last attempt from the portfolio management chapter alone, out of 33 bullet MCQs, 5 MCQs appeared in examination, June 2025, 5 MCQs. Okay. So that's why day 1, today our target is to complete portfolio management, and next day 2, derivatives. Day 2, derivatives. Okay. And next day 3, security valuation and evaluation of risky proposals. Day 4, mutual funds, super 50 questions from investment decisions and leasing. So day 5, forex, super 50 questions. Forex super 50 questions. So do not ask me the timings of a class. I told you the target. What is the target? Today's target is to complete portfolio management. Okay. If you are completing this portfolio management chapter within 1 hour, then our class will end by what? 5:30. If you are completing this class, practice within 2 hours, then our class will get completed by 6:30. So that depends on you when the class is going to end. Okay. Next, I'm dedicating this class revision series to all working or married men and women who are preparing for CMA, because it is not that easy to complete CMA while working or after marriage. Okay. And also my Coal India friends and my guru R.K. Sahai, sir, ex-director finance of Bharat Coking Coal Limited, subsidiary of Coal India Limited. Okay. So next, gratitude. If you want to show gratitude to this class, please like, share, comment, subscribe, and click on bell icon. Okay, because face-to-face students, okay, fine, because they will give a smile if they like class. Okay, I will know the response of the class. I can know the feedback of the class, right, by seeing the smile. But online students I cannot see. So that's why at least what comment. Okay, and please do attend felicitation program with parents at the rate BCCA main branch Nujvid, Andhra Pradesh in the month of February after your results, after getting qualification or securing rank. Even if you sell rank to anyone else, that is not matter at all. But at least please do attend felicitation program with parents. Okay, so that is life in the life. I mean, at least once you should make parents proud. So that's why please do attend and refer our regular classes to your juniors. Now sources considered. So what are the sources considered, Varsha? Okay, it is very new to me, but I'm trying to promote my classes. Okay, please do not laugh. So sources considered for this material. So okay, I have considered CMA final study material, which are not common for CA. For example, investment decisions chapter is not there in CA final AFM. So for that, I have considered CMA final study material. But for the common chapters like portfolio management, derivatives, forex, I have considered CA final study material, because in CMA exams, all questions are being asked from CA final study material. So that's why I have considered CA final study material and CMA final study material, CA final past papers and CMA final past papers, and also CMA workbook. So that's why you need not worry, because 10 days before the exam or 15 days before the exam, in Telegram group questions, students will be asking the doubts like, sir, what about workbook? I should do it or not? Okay. You need not go through any other source. You just rely on the book or a PDF which is provided to you. Okay. Clear? And for any doubts or resources, please join our Telegram groups. Okay, total 8 groups were created for CMA final, exclusively for all subjects. For SFM there is a separate group, and for DT, direct tax, and tax, indirect taxes, so there is only one group, because direct taxes and indirect taxes, Varsha's favorite faculty, sir Mandeep sir, is dealing DT and IDT. Okay, so there is only one group. And for SCM and SPMBV, Pravalika's favorite faculty, so Rajesh sir, so there is one group. Please join the group. And my boss and my home minister Bhavya ma'am, she is dealing law. Okay, I follow her orders blindly. Okay, so she is dealing law. You can join that group. And Raviteja sir, he is dealing CFR. Raviteja sir, please join the group. And what else? Parvati ma'am, sorry. Parvati ma'am. Actually, I'm dedicating this class to Parvati ma'am, because she is married and while working she completed CMA. Okay, so Parvati ma'am, she is dealing cost audit. So you can join that group. Okay, clear? Thank you. So that's all. Now let us start portfolio management. Portfolio management. Okay. Sure, Shiva. Portfolio management. So portfolio means a combination of securities, stock, bonds, money market instruments. So money market instruments, example, treasury bill, commercial paper, certificate of deposits, etc. Okay. So portfolio means a combination of securities. Portfolio management involves three major activities. Selection of a securities based on return and risk. So return is missing. So please write down selection of securities based on return and risk. Construction of all feasible portfolios, deciding weights of a different securities. So in this chapter, mainly we are going to learn how to calculate the return and risk of a security as well as portfolio. So objectives of a portfolio management: safety of a principal amount, stability of a income, capital growth, marketability, liquidity, and diversification. Next, the phases of a portfolio management: stages of a portfolio management: security analysis, portfolio analysis, portfolio selection, portfolio revision, portfolio evaluation. For every stage we have a question, sir. Okay, so we are going to solve practical questions for security analysis, portfolio analysis, and also portfolio selection, portfolio revision, portfolio evaluation. Okay. Wealth maximization. The basic objective of SFM is to maximize the wealth. Wealth depends on two factors, the profit and risk. If a profit increases, wealth increases, and vice versa. Okay. If risk increases, wealth decreases. Okay, because the expectation increases. If risk increases, expectation increases. And if expectation increases, what happens? Wealth decreases. So that's why objective of a portfolio management is to select a portfolio which is having a lesser risk. Lesser risk. The fund manager, portfolio manager objective is to maximize, okay, return and minimize the risk, because wealth depends on two factors. One is profit and second one is risk. Clear? And next, return and risk of a security. First, return and risk of a security. So equity shareholder will get return in the form of capital appreciation and dividend. Debenture holder gets return in the form of interest and capital appreciation. Okay. So before learning the advanced concept like return and risk of a portfolio, first we should know how to find out the return and risk of a security. How we find out the return of a security? Return of a security is equal to P1 minus P0 plus D1 divided by P0. P1 minus P0 is nothing but capital appreciation. P0 is the investment at the beginning. So return X is equal to P1 minus P0 plus D1 divided by P0. Expected return X bar is equal to average of X. So if a past data is given, we do simple average. And if a probability is given, we do weighted average. If a probability is given, we do weighted average. Okay. Risk of a security. You should know the meaning of a risk. Risk means uncertainty, possibility of occurrence of a loss, possibility of uncertainty. Okay. Possibility of occurrence of loss and possibility of deviation from the mean. Mean means average. Mean means average. So possibility of deviation from the average. You should remember this word, possibility of deviation from the average. Okay. So how the risk of a security is measured? Risk of a security is measured using variance, standard deviation, or a coefficient of a variance. Coefficient of a variance. So variance is sigma x square. How it is denoted? Sigma x square. Sigma x square is equal to summation sigma x minus x bar square divided by n. Or when probability is given, summation sigma p into x minus x bar square. Standard deviation sigma x is equal to square root of a variance. Square root of a variance. And you have to be careful when the probability is given. So this is important actually. So rather than the formula, columns are very important. So what are the columns we should take for calculation of a risk? X, x bar, x minus x bar, x minus x bar whole square. You can easily remember these columns because risk means a possibility of a deviation from the mean, average. So that's why we are taking x, x bar, average. X minus x bar is nothing but deviation. But if you take the total of deviation, you will get 0. So to eliminate the negative sign, we are taking square. So x, x bar, x minus x bar whole square. So sir, when we use n minus 1, we are not going to use divided by n minus 1. In CMA final study material, in few questions, they have mentioned n minus 1. But whereas in suggested answer, generally what? They will take n. In CA final and CMA final suggested answers, they will be taking what? N divided by n. So n minus 1 they will not be taking. Okay. So future data, when future data is given, you have to be careful. Probability is given. When probability is given, what are the columns? X, P, P into X, X bar, P into X minus X bar whole square, P into X minus X bar whole square. So X, P into X. Because when probability is given, we have to do weighted average, weighted average. So these are the columns. Coefficient of a variation. So they are asking multiple choice question on this coefficient of a variation. So one of the frequently asked MCQ. Coefficient of a variation or variance is equal to sigma x divided by x bar. It denotes risk per 1 unit of expected return. Risk per 1 unit of a expected return. So this is frequently asked multiple choice question. Coefficient of a variance. Next. So before moving on to the part 2, return and risk of a portfolio. Return and risk of a portfolio. So here you have a question number 1. Question number 1. So question number 1 is simple. I mean, this question during the last revision you need not refer. Question number 1 is what? Simply they are asking risk of a security with probability. Risk of a security with probability. So when probability is there, tell me the columns. You need not practice this question. You need not practice this question. Tell me the columns. X, P into X, X bar, P into X minus X bar whole square. X, P into X, X bar, X minus X bar, P into X minus X bar whole square. So these are the columns. Okay. And how we find out this X is equal to P1 minus P naught plus D1 divided by P naught. In this question, dividend is not given. Dividend is not given. Okay. Clear? Question number 1. So this question you need not practice. So question number 2. Okay. That is relating to the return and risk of a portfolio. How we find out the return and risk of a portfolio? Return and risk of a portfolio. Okay. Portfolio return is nothing but weighted average of a security return. Weighted average of security return. So P bar is equal to WX X bar plus WY Y bar. WX X bar plus WY Y bar. If there are 3 securities, then we take WX X bar plus WY Y bar plus WZ Z bar. Portfolio risk. Portfolio risk. So portfolio risk we cannot do weighted average of security risk. We cannot do weighted average of a security risk. Because the main object of a portfolio investment is to diversify the risk. Diversify the risk. We should not put all eggs in one basket. We should not put all investment in one security. So we have to diversify the risk. To diversify the risk, what we are doing is we are making investment in 2 or more securities. So that's why while calculating the risk of a portfolio, we should consider correlation coefficient. Correlation coefficient. So what is this correlation coefficient? Correlation coefficient denotes closeness of securities. Closeness. How close are the securities? How the securities are moving. So sigma xy can be -1, +1, 0, -1 to 0, 0 to 1. There can be 5 scenarios. There can be 5 scenarios. So -1. So sigma xy is equal to -1. Sigma xy means correlation coefficient. It denotes closeness of a security. Sigma xy is equal to -1. What does it indicate? It indicates securities are moving in opposite direction and in same proportion. Same proportion. Opposite direction and in same proportion. So if sigma xy is equal to +1, it indicates securities are moving in same direction and in same proportion. For example, HDFC Bank and HDFC Limited. Okay, before merger, HDFC Bank and HDFC both were into the same business. They were doing the same, okay, kind of a transactions. So then what happens if HDFC increases? What happens to the HDFC Limited? HDFC Limited will also increase. Clear up. So here the formula is reverse. So I will tell you. So when sigma xy is equal to -1, sigma xy is equal to -1, sigma p is equal to wx, sigma x minus wy, sigma y. Okay. When sigma xy is equal to plus 1, then sigma p is equal to wx sigma x plus wy sigma y. So when sigma xy is equal to plus 1, we can do directly weighted average of a security risk, because sigma xy plus 1 means what? Securities are moving in same direction and in same proportion. So if they are moving in same direction and in same proportion, the risk cannot be diversified. So that's why sigma p is equal to wx sigma x plus wy sigma y. Okay. And next, sigma xy is equal to 0. Sigma xy is equal to 0 means no relation between two securities. No relation between two securities. No relation between two securities or independent. Two securities are independent of each other. Independent of each other. Why I am mentioning this independent word? Because the reason in CA final one past question, if a correlation between two securities is independent, if a correlation between two securities is independent, then sigma p is equal to. So how do you get sigma p? Sigma p is equal to square root of wx square sigma x square plus wy square sigma y square. Sigma y square. So we have seen the logic, okay, during the regular classes. Now I am not explaining these. So next, minus 1 to 0. Sigma xy minus 1 to 0. Sigma xy minus 1 to 0 means what? Securities are moving in opposite direction but not in same proportion. 0 to 1. 0 to 1. 0 to 1 means securities are moving in same direction but not in same proportion. But not in same proportion. So when sigma xy is equal to minus 1 to 0 or 0 to 1, then we should apply Markovitch modern portfolio theory formula, that is sigma p is equal to square root of sigma p is equal to square root is missing, okay. Sigma p is equal to wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy, or square root of wx square sigma x square plus wy square sigma y square plus 2wx wy covariance of x comma y. Okay. So sigma xy means correlation coefficient. It denotes closeness of our securities. There can be 5 scenarios. Sigma xy minus 1, plus 1, 0, minus 1 to 0, 0 to 1. Okay. If it is minus 1, sigma p is equal to simple a minus b. Wx sigma x minus wy sigma y. If it is plus 1, sigma p is equal to wx sigma x plus wy sigma y. If it is 0, then what? Square root of wx square sigma x square plus wy square sigma y square. And be careful, in question they might mention two securities are independent of each other. Independent of each other means sigma xy is equal to 0. Two securities are perfectly positively correlated. Plus 1. Two securities are perfectly negatively correlated. Minus 1. Minus 1. Clear? So now here you should know sigma xy. So minus 1 to plus 1. When sigma xy is equal to minus 1, sigma xy is equal to minus 1, risk can be reduced to 0. Risk can be completely reduced to what? 0. Further, weight of x is equal to sigma y divided by sigma x plus sigma y. Okay. And if it is plus 1, risk cannot be diversified. Risk cannot be diversified. But however, if it is 0 or minus 1 to 0 or 0 to 1, risk cannot be reduced to 0, but risk can be minimized. Risk can be minimized. Nothing but when sigma xy is other than minus 1, when sigma xy is other than minus 1, for construction of a minimum risk portfolio, high chances of forgetting this formula. High chances you might forget this formula. So when sigma xy is other than minus 1, anyway, if it is plus 1, risk cannot be diversified. But if it is minus 1, risk can be reduced to 0. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. But when correlation coefficient is other than minus 1, For construction of minimum risk portfolio, weight of X must be equal to sigma Y square minus covariance of X comma Y divided by sigma X square plus sigma Y square minus 2 covariance of X comma Y. Sigma Y square minus covariance of X comma Y divided by sigma X square plus sigma Y square minus 2 covariance of X comma Y. Okay. So how to find out the return and risk of a portfolio? So first, to find out the return and risk of a portfolio, first step one, you should find out what X bar, Y bar. We should know the average return of a securities. Average return of securities. Step 2, we should find out sigma X, sigma Y. We need standard deviation of a securities, because sigma P is equal to square root of WX square, sigma X square. WX means weight of X, proportion of investment in X, security X. And next step 3, covariance of X comma Y. What is this covariance of X comma Y? Covariance of X comma Y denotes co-movement of the securities. It does not denote the closeness of securities, but it denotes co-movement of the securities. Covariance of X comma Y ranges from minus infinity to plus infinity. If covariance of X comma Y is minus 1, securities are moving in opposite direction. If it is plus 1, securities are moving in same direction. But covariance of X comma Y does not denote how close are the securities. Step 4, we should find out sigma XY. Why we should find out sigma XY? If we find out sigma XY, if it is 0, we use square root of A square plus B square. If it is minus 1, we use A minus B. If it is plus 1, we use A plus B. Or else what we use? Lengthy formula, that is square root of WX square sigma X square plus WY square sigma Y square plus 2WX WY sigma X sigma Y sigma XY. Or else instead of sigma X sigma Y sigma XY, we can use covariance of a X comma Y. Sir, how to find out covariance of X comma Y? Simple. What does the covariance denotes? Covariance denotes co-movement of the two variables, two securities. So that's why covariance of X comma Y is equal to, we should multiply deviation of X into deviation of a Y. Deviation of X into deviation of a Y, because covariance denotes co-movement of the securities. Okay. So covariance of X comma Y is equal to summation sigma X minus X bar into Y minus Y bar divided by N when past data is given. But be careful, high chances of doing clerical mistake when the probability is given. When probability is given, covariance of X comma Y is equal to summation sigma P into X minus X bar into Y minus Y bar. So you should know the columns, main important columns. For covariance of X comma Y, what are the columns? Covariance of X comma Y. If a past data is given, what are the columns? X minus X bar, Y minus Y bar, X minus X bar into Y minus Y bar. Future data. Future data. When future data, probability is given, X minus X bar, Y minus Y bar, P into X minus X bar into Y minus Y bar. So there is another formula for covariance of X comma Y. So what is the other formula? Sigma X, sigma Y, sigma XY. Sigma XY. And there is another formula, high chances of forgetting this formula. Covariance of X comma Y is equal to beta X, beta Y, sigma M square. Beta X, beta Y, sigma M square. Beta X, beta Y, sigma M square. So this is the formula. You might forget, high chances of forgetting this formula. Covariance of X comma Y, beta X, beta Y, sigma M square. And here one formula is missing, that is sigma XY is equal to sigma XY. Correlation coefficient sigma XY is equal to covariance of X comma Y divided by sigma X, sigma Y. Sigma X, sigma Y. Okay. So till now we have completed what? Recalling return and risk of security and return and risk of portfolio. Return and risk of a portfolio. Okay. Now your time arrives. Okay, you have to practice what? Questions. Okay. So not every question need to be practiced. For example, question number 2, it comes under A category. A category means what? No need to refer at all. No need to refer at all. So question number 2, no need to refer at all. But let us see the columns. So what they are asking? They are asking you to find out the covariance and correlation. These are not the practice questions. Wait. Your time will come, okay? You have to practice questions, but this is not the question to practice. Covariance and correlation coefficient. How do we get correlation? Covariance. Covariance. X comma Y. Two securities are given, past data is given. Past data. Two securities and past data is given. Jagan Ongol Bulls. You will get notes in Telegram group. Okay, Telegram link provided in description. So covariance and correlation coefficient. So how do we get correlation coefficient? Correlation coefficient is equal to covariance of X comma Y divided by sigma X sigma Y. So that means first we should find out what covariance of X comma Y. Covariance of X comma Y. This is past data, right? So this is past data. So how do we get covariance of X comma Y columns? What are the columns for covariance of X comma Y? X minus X bar, Y minus Y bar, X minus X bar into Y minus Y bar. Clear? But we need sigma X and sigma Y to find out what? Correlation coefficient. So that means here simple. First step is to find out sigma X. Second step sigma Y. And then what? Covariance of X comma Y. So tell me the columns for sigma X. X, X bar, X minus X bar, X minus X bar whole square. And next Y, Y bar, Y minus Y bar, Y minus Y bar whole square. Covariance of X comma Y columns. X minus X bar, Y minus Y bar, X minus X bar into Y minus Y bar. Am I clear? So question number 2 is not for reference at all, but it doesn't mean it is not, it will not come in examination. So this is CA final pass exam question, CMA final pass examination question. Every question in portfolio management was asked in past. Okay, but okay. So why I'm not asking you to practice, because the reason is what? This is a basic question. You will remember the column, so that's why. Next, question number 3 and question number 4 also. So today you can refer, but later on not required. So question number 5. Okay. So now this is your time. Question number 5. So let us see what is this question number 5. Return and risk of a portfolio. This is a CA final recent past question and also CMA final past question. Question number 5. An investor has decided to invest 1 lakh in the shares of 2 companies, ABC and XYZ. The projections of returns from the shares of 2 companies along with their probabilities are as follows. In portfolio management, there are 11 practice questions, only 11 practice questions. You have to practice only 11 questions, okay? And you should check whether you are able to solve this question within 15 minutes or not. 13.65 actually. You should check whether you are able to solve this question within 13.65 minutes or not. You have to check. Okay. So there are how many questions? 11 practice questions. 11. For all these 11 questions, I will give you 10 to 15 minutes time to solve. You have to practice. Clear? So 1 lakh invested in ABC and XYZ. The projections of returns from the shares of the 2 companies along with their probabilities are as follows. Returns are given and also probabilities are given. Probability 0.2, 0.25, 0.25 and 0.3. ABC 12, 14, minus 7, 28. Return is given. XYZ 16, 10, 28, minus 2. You are required to comment on return and risk of investment in individual shares. So we have to comment on return and risk of the shares. So first we should find out the return and risk of shares. Return means here expected return, average return. Probability is given. How do we get expected return? When probability is given, we have to do weighted average. What about the risk of a shares? Risk. When probability is given, risk columns. X, P into X minus X bar, P into X minus X bar whole square. Next, compare the return and risk of these two shares with portfolio of these shares in equal proportions. So they are asking you to compare the return and risk of the portfolio with the two shares. Okay, and how the investment is being made in two securities? Equal proportion, 50-50. 50-50. That means weight of A is equal to 50, weight of B is equal to 50%. Next, third, find out the proportion of each of the above shares to formulate a minimum risk portfolio. Find out the proportion. You should understand the question. Find out the proportion of each of the above shares to formulate a minimum risk portfolio. To formulate minimum risk portfolio, find out the proportion. Nothing but we should apply the formula. Weight of X is equal to. First we should find out sigma xy. If you find out sigma xy, then you will understand which formula to be applied. Okay, clearer? Now you take 13.65 minutes. Now the time is 5. So by 5:13, you should complete this question. You should complete all the 3 parts with the presentation. With the presentation. Okay. Now every online student, please, you have to practice this question. Question number 5, you have to practice. By 5:13, you have to complete this question. Mention your answer. Question number 5. Offline students who completes first will get 1 apple. 1 apple. It's serious. I bought 11 apples. Because there are 11 practice questions. 11 practice questions. With the presentation. With the presentation. Sahil, try to solve this question as soon as possible. Expecting everyone to practice. Or else at least try to understand the solution in next 13 minutes. Students who have started the preparation just now, at least try to understand. So this question comes under A++ category. That means you have to practice. Mahima Singh, why not getting good marks in SFM? Reason lack of a practice, students not practicing the question, so that's why. CMA student return 12.55% and the standard deviation portfolio risk 1.25%. Huh? Very good CMA student. Mahima Singh, I have already told you the reason, because the students are doing a clerical mistakes and also basic conceptual mistakes. So that is the main reason. They are just understanding the concepts, but they are not checking whether they are able to do the question within the time or not. So this week I will set the SFM paper question, SFM paper, and I will give easy questions, but you will not be able to do easy questions. Very good, Sahil. Bharat sir, bring one apple. CMA student got 52 in June 25. Okay. CMA student, this time our target is 70 plus. Sahil. With the presentation, you have to complete within the time with presentation. With heading, you have to take heading, everything. With the presentation, you have to complete. If you're not able to complete within 15 minutes, then what? Again, you have to practice. I have shared the solutions in Telegram group. You can go through the solution at least. If question number 5 is completed, then what? You can go for question number 6. So students who are comfortably completed, comfortably completed question number 5, they can go for what? Question number 6. Question number 6 is also a plus question, practice question. If you're practicing these 11 questions, so these 11 questions are going to cover entire concepts. You have to practice each and every 11 questions, each and every question. Yes, if you take x minus x bar total, here you will not get 0 because the reason is we have a probability. But if you do the weighted average of x minus x bar directly, then you will get 0. We should not directly do weighted average of x minus x bar. We should do weighted average of x minus x bar square. Fight and 3 more minutes. In 3 more minutes, you have to complete this question. Very good. Here in offline class, Vishnu has completed the question. So we are giving apple. Pandu 1, Pandu. First apple goes to Pandu. Two more minutes. In exam center, invigilator might be saying like this, okay, 2 more minutes. Now you should feel the pressure. Very good, Vinila. What about Pravalika, class representative? So understanding concept is not enough. You have to complete the question within the time. That is very important. Earlier in SFM, they used to ask the same question for 10 marks, 12 marks, 8 marks. Earlier they used to ask the same question for 10 marks. Now they are asking a question for 7 marks. You will get known questions in exams, but may not be able to do within the time. Done. Your time is up. 5:13. Okay, 1 more minute. 5:14. At least complete by 5:15. Harini, very good. So first part, they have asked you to find out return and risk of a security. How to find out the risk of a security? Here the probability is there. So that's why what are the columns? X, P, P into X, X bar, X minus X bar, P into X minus X bar whole square. So what is the standard deviation of X? 12.95%. Okay. The next standard deviation of Y is equal to 11.27%. So they asked you to comment. So security XYZ is giving a less return for less risk. ABC is giving a higher return for high risk. Yes or no? So that is the first part. What is the second part? They ask you to compare return and risk of a security with return and risk of a portfolio. So okay. So to find out the risk of a portfolio, so we already know sigma X and sigma Y. Next step is to find out what covariance of X comma Y. Here we have a probability. Be careful, we have a probability. So what are the columns we should take? X minus X bar, Y minus Y bar, P into X minus X bar into Y minus Y bar. So what is the covariance of X comma Y? Minus 0.98. Minus 0.98 covariance of a X comma Y. So but before finding out covariance of, what is the covariance of X comma Y? Covariance of X comma Y is equal to minus 144. Minus 144.254. Covariance of X comma Y is equal to minus 144.254. Sigma XY is equal to minus 0.98. What is the meaning of this minus 0.98? Minus 0.98 is nothing but, what does it mean? Securities are moving in opposite direction, almost same proportion, So next sigma P is equal to, we cannot apply the simple formula A minus B, yes or no? Because sigma XY ranges from minus 1 to 0. Minus 1 to 0. Okay, so that's why square root of Wx square sigma X square plus Wy square sigma Y square plus 2Wx Wy sigma X sigma Y sigma XY. So the answer is 1.25%. Portfolio return P bar is equal to Wx X bar plus Wy Y bar. So answer is 12.325%. So this is the beauty of a portfolio management. If you see the return of a portfolio is 12.325, but the risk has got almost diversified. Because ABC risk is 12.95, XYZ risk is 11.27, but the risk of a portfolio is 1.25%. Here the risk has got diversified. Okay, because the reason is securities are moving in opposite direction and in almost the same proportion. So that's why. Last part. So they're asking you to find out the proportion of the above share for construction of a minimum risk portfolio. Minimum risk portfolio. So weight of X is equal to sigma XY is equal to minus 0.98. So that's why we should apply. So okay, weight of X is equal to what? Sigma Y square minus covariance of X comma Y divided by sigma X square plus sigma Y square minus 2 covariance of X comma Y. So weight of X is equal to 46% and weight of Y is equal to 54%. Clear? And we have a additional question number 12. Additional question number 12. So additional question number 12 is the past examination question. It is A plus category. That means you have to refer the question. So almost same. But the only difference is additional question number 12. So almost same. Probability is given. Returns of two securities are given. First part, they asked you to find out expected return and standard deviation and also correlation coefficient. Second part, comment on risk and return of these two shares and portfolio with equal proportions. But last part is determine the expected rate of a return of zero risk portfolio. Determine the expected rate of a return of a zero risk portfolio consisting of above two stocks. Zero risk portfolio. Zero risk portfolio means risk can be reduced to 0 when sigma xy is equal to -1. In this question, you will get sigma xy -1. In this question, you will get sigma xy -1. So when sigma xy is equal to -1, when sigma xy is equal to -1, here covariance of xy is mentioned, but it is sigma xy. When sigma xy is equal to -1, we can reduce the risk to 0. We can reduce the risk to 0. Clear? We can reduce the risk to 0. Okay. So how can we reduce this risk to 0? For reducing the risk to 0, weight of x must be equal to sigma y divided by sigma x plus sigma y. Sigma y divided by sigma x plus sigma y. Clear? You have to apply that formula. You will get weight of x. Here the answer is wrong. Okay, I am explaining the answer. So weight of x is equal to sigma y divided by sigma x plus sigma y. Okay, you should find out the weight. But the question is what? They are asking you to find out the expected rate of a return of a zero risk portfolio. They are not just asking you to find out the weight. They are asking you to find out what? Expected return of a zero risk portfolio. How do we get expected return? Simple, by doing a weighted average. How do we get weighted average? Wx x bar plus Wy y bar. Wx x bar plus Wy y bar. Am I clear? So you have to refer this question, additional question number 12. So that to third part. You have to refer third part. You have to refer third part. You should understand the meaning, expected return of a zero risk portfolio. Am I clear? Next. Question number 6 is also for practice. Question number 6. Question number 6. So this question definitely you will not be able to complete within 13.65 minutes. You are not going to complete this question within 13.65 minutes. Sure. Question number 6. So this question is A plus plus question. A plus plus. You have to practice this question. You have to practice this question. X company limited invested on 1/4/2009 in certain equity shares as below. Name of a company M limited, N limited, number of shares 1,500, cost 2 lakhs, 1 lakh 50. In September 2009, 10% dividend was paid out by M limited, and in October 2009, 30% dividend paid out by N limited. On 31st March 2010, market quotations showed a value of rupees 220 and 290 per share for M limited and N limited respectively. On 1/4/2010, investment advisors indicate that the dividends from M limited and N limited for the year ending 31st March 2011 are likely to be 20% and 35% respectively, and that the probability of market quotations on 31st March 2011 are as below. Probability factor 0.2, 0.5 and 0.3. Price per share of M limited 220, 250 and 280. Price per share of N limited 290, 310 and 330. You are required to calculate the average return from the portfolio for the year ended 31st March 2010. Calculate the expected average return from the portfolio for the year 2010-11 and advised X company limited of the comparative risk in the two investments by calculating the standard deviation in each case. For the first time you may not be able to understand the question. Of course, second time also you may not be able to understand the question. Third time also you may not be able to understand the question. Then how can you solve within 13.65 minutes? So that's why this question comes under what? A plus plus category. A plus plus category. Okay. So 90% of the students may not be able to recall the concept. May not be able to understand the question, I think. Okay. So they're asking you to find out what average return of a portfolio and also what expected return of a portfolio for the year 2010-11. Advise X company limited of the comparative risk in the two investments by calculating standard deviation in each case. Okay, I think you may not be able to recall this question. So that's why I'm explaining the question. But you have to practice this question. Today, after this class, you have to practice this question. So what they are asking you to find out the average return of a portfolio for the year ended 31st March 2010. So 31st March 2010. Price at the beginning. Price at the beginning. P naught. What is the price? 2 lakhs divided by 1000. So the investment at the beginning is 2 lakhs. Number of shares. Number of shares. 1000. So what is the P naught? P naught is equal to 200. What is the price at the end of the first year? Price at the end of the first year is given in the question. Okay. So they are asking you to find out what? Expected return for the year ended 31st March 2010. Simple. Price at the end is given. What is the price at the end? 220. So dividend, 10% dividend was paid out by M Limited, 10%. So what is the face value? 100. So 100 into 10%, 10 rupees. So what is the solution? 220 P1 minus P0 200 plus D1 10 divided by 200. So the answer is 15%. Clear? Next, the return of unlimited. Return of a unlimited. So what is the P0? What is the investment? 1,50,000 divided by 500 shares. So P0 is equal to 300. P1 is given in the question 290. Dividend for the year 3 rupees. Dividend for the year 3 rupees. Be careful. High chances of doing a clerical mistake because the face value of a unlimited is 10 rupees only. You might take 100. Be careful. 10 into 30%, 3 rupees. So return is equal to 290 minus 300 plus 3 rupees divided by 300. So minus 2.33. So they're asking you to find out the expected return of a portfolio. How do we get expected return of a portfolio? By doing a weighted average. Here weights are not directly given, but investment amount is given. So 2 lakhs divided by 3,50,000 into 15% plus 1,50,000 divided by 3,50,000 into minus 2.33%. So the answer is 7.57%. So this is the first part. So what is the second part of the question? Second part of the question. So calculate the expected average return from the portfolio for the year 2010-11. For the year 2010-11. For the year 2010-11. For the year 2010-11, what is the P naught? Okay, P1 for 910 is nothing but what? P naught for 10-11. So price at the beginning 220. Price at the end is not directly given. So prices with probability are given. Prices with probability are given. The probabilities of market quotations and probability and market quotations are given. So that's why what is the P naught expected price? P naught expected price is equal to 220 into 0.2 plus 250 into 0.5 plus 280 into 0.3. So the answer is 253. So dividend for the year is equal to 100 into 20%. So next year dividend rate is 20%. So return of a security unlimited is equal to 253 minus 220 plus 20 divided by 220. So the answer is 24.09%. 24.09%. Likewise, we should find out the return of unlimited. In the same manner, we have to find out the return of unlimited. So what is the return of unlimited? 8.79. 8.79. But how do we get expected return of a portfolio? Weighted average. Be careful. Here again, high chances of doing a clerical mistake. Weights are going to change for the next year, because investment at the beginning are not same for the next year. So what are the investments at the beginning next year? 220 into 1000 shares, 2,20,000. What about the second share? 500 shares into 290. So the investment is equal to, overall investment is equal to 2,20,000 plus 1,45,000. 3,65,000. So 2,20,000 divided by 3,65,000 into 24.09 plus 1,45,000 divided by 3,65,000 into 8.79. 18.02% is the answer. Am I clear? Done. Now comes the last part, standard deviation. Standard deviation. Here the probability is given. Probability is given. When probability is given, how we get the standard deviation? Standard deviation columns x, p, p into x, x bar, x minus x bar, p into x minus x bar square. Probability is given. How many possibilities are given? 3 possibilities are given. 3 possibilities are given. Yes or no? First possibility, price at the end of the year will be 220. Price at the end of the year will be 220. Second possibility, price at the end of the year will be 250. Third possibility, price at the end of the year will be 280. So, okay, how to find out x? P1 minus P0 plus D1 divided by P0. So, first possibility 9.09. First possibility 9.09. What is the second possibility? 22.72%. If a price increases to 250, if a price increases to 250, then what is the return? 22.72. If the price increases to 280, then 36.36. So by doing weighted average, we get 24.086, nothing but 24.09, 24.09. So 24.09 is x bar, x minus x bar, p into x minus x bar square. Okay, so answer is 9.54% is the standard deviation of x. In the same manner, we have to do for y also. Y also. So this question you have to practice. You may not be able to understand this question, so be careful. You have to practice this question. Okay. You have to practice this question. Please go through the solution. Any doubt, please let me know. Any doubt, let me know. CMA student. This question is for practice. Today, after the session, you have to check whether you are able to solve within 13.65 minutes or not. Everybody, online students, are able to understand? Why we have taken P0 as 220 for the next year? For the next year, why we have taken P0 as 220? Because the reason is, this year ending price is next year opening, right? So for 31st March 2010, what is the price? What is the price on 31st March 2010? 220. So that is closing for what? 910. But opening for what? 1011. So that's why for 1011, P0. So we have taken 220 as a P0. Okay. So this question you have to practice. Done. So next question, 7, you need not refer. 7th question comes under A plus I mean, you have to refer 7th question, A plus seventh question you have to refer. So simple question, 7th question. Markovitch rule of a dominance. Markovitch rule of a dominance. Following is the data regarding 6 securities A, B, C, D, E, F. Return and risk is given. Assume 3 securities have to be selected. State which one will be picked. State which one will be picked. Rule of a dominance. Markovitch rule of a dominance. Markovitch rule of a dominance. One security is said to be dominating the other security if the security is giving higher return for same risk, same return for lower risk, higher return for lower risk, or high return for higher risk. One security is said to be dominating the other security if the security is giving high return for same risk, or high return for low risk, or same return for low risk, or high return for higher risk. So for example, in this question, security A is giving same return for lower risk. When you compare with B, when you compare with B, A is giving same return for low risk. But when you compare with C, no security is dominating because the reason is C is giving high return for high risk. But if you compare with the D, A is giving high return for same risk, high return for same risk. So when you compare A and D, I am going to select A. What about E? When A and E are compared, E is giving higher return for high risk. So tell me, am I going to eliminate E or not? No. What about F? When I compare A and F, A is giving same return for low risk. So that's why we are not going to select F because A is dominating F. So if 3 securities have to be selected out of 6, I'm going to select A, C, and what? E. I'm going to select A, C, and E. Assuming perfect correlation, show whether it is preferable to invest 75% in A and 25% in C, or to invest 100% in E. Assuming 100%, assuming perfect correlation. Perfect correlation means what? +1. Perfect correlation. So they are not mentioned whether it is positive or negative. Okay, if nothing is mentioned, then that means what? It is positive. So assuming perfect correlation, that is +1. State whether it is preferable to invest 75% in A and 25% in C. So that is one option. Second option, invest all 100% in, invest entire 100% in E. If you are investing 100% in E, then the return is 9%, risk 5%. Risk 5%. Clear? So what about the first option, 75% in A, 25% in C? When the correlation coefficient is +1, how do we get sigma P? Sigma P is equal to Wx sigma x plus Wy sigma y. Wy sigma y. Clear? So how do we get risk of a portfolio? 75% into 4 plus 25% into 12. 3 plus 3. 6% is the standard deviation of a portfolio. What about the return? 75% in 8, 6 plus 25% in 12, 3. Overall 9. So nothing but first option, you are getting 9% return for 6% risk. But if you are investing 100% in E, then you will get 9% return for 5% risk. Which is the better option? Investing 100% in E, because we are getting same return for low risk. Same return for low risk. So question number 7 you have to refer. You have to refer. 8th question you need not refer. 8th question you need not refer. Okay. 8th question. And also 9th question you need not refer. 10th question you have to practice. This comes under A++. This comes under what? A++. Okay. So now I'm giving time 10 minutes. But before 10 you complete what? Question number 6. Completed, huh? Everybody. Question number 6. Question number 6. Now itself you complete, okay? Because some students might be facing difficulty, so that's why you practice now itself 10 minutes. By 5:51 complete question number 6. Complete now itself. Pause the video and complete within 10 minutes. If you want 60 marks in SFM, you have to prepare for 70, because they will give wrong answer, suggested answer, at least for 17 marks and 1 MCQ. If you see the June 25 suggested answer, for 1 MCQ they have given all options, A, B, C, D, all options, and for 1 MCQ they have given 2 options. Because in study material they have mentioned wrong answer. So that's why they have given 2 answers for 1 MCQ, and for 1 MCQ they have given 4 answers. And Forex suggested answer wrong. So that's why if you want 60, you should prepare for. Everybody is clear? Question number 6. Next practice question, question number 10. So next concept, beta. So what is this beta? Security beta and portfolio beta. Next concept. So total risk is equal to systematic risk plus unsystematic risk. Systematic risk is a country specific. Unsystematic risk is a company specific or a industry specific. For example, okay, X Limited company CEO has died. X Limited company CEO died. Then what happens? Only X Limited share price will get affected, yes or no? Y Limited share will not get affected. So if some CEO resigns or CEO dies, then that is an example for what? Unsystematic risk. It is a company specific or a industry specific. It can be diversified. We can call it as residual variance also. Unsystematic risk, we can call it as residual variance. And if a labor of a particular company doing a strike, then that is also an example for what? Unsystematic risk. Systematic risk is a country specific. Example, Corona, COVID. COVID is an example for what? Systematic risk. So it cannot be diversified. Beta denotes systematic risk. Okay. So GDP, inflation, interest rates, they are going to affect all the companies, not a single company. For example, change in GST rates going to affect what? All the companies, not just one company. So that's why that is an example for what? Systematic risk. Beta denotes systematic risk. Beta is also called as sensitivity of a return. It denotes responsiveness of security return with respect to market. With respect to change in market. Responsiveness of a security return with respect to change in market. For example, high beta indicates high risk. High beta indicates high risk. So beta can be positive, negative. Beta can be positive, negative. Beta positive means the same direction. Negative means opposite direction. Beta positive. Beta of X limited is positive. Beta of X limited positive means what? Both X limited company and the market are moving in same direction. Whenever I say market in SFM class, market means index. Index means what? Nifty or a Sensex. Here market means index. Nifty or a Sensex. So beta positive means what? So both security and market are moving in same direction. Beta negative means security and market are moving in opposite direction. Beta zero means there is no relation between the security and market. There is no relation between security and market. Okay, beta denotes responsiveness of a security with respect to change in market. Okay, clear? So generally beta of a company will be positive because company and market will move in the same direction generally. Okay, so beta, security beta. How do we calculate security beta? Only when 2-period data is given. 2-period data is given, then change in security return divided by change in market return. Change in market return. When more than 2 periods data is given, then beta is equal to covariance of SM divided by sigma m square. S means security, M means market. So nothing but co-movement of security and market divided by sigma m square. Why we are taking co-movement of security and market? Because beta denotes responsiveness of security and market. So that's a covariance of S comma m divided by variance of a market. Or else, second formula, sigma SM. Sigma SM means a correlation coefficient of security and market into sigma S divided by sigma m. Standard deviation of security divided by standard deviation of a market. Sigma SM denotes closeness of security and market. Closeness of security and market. Okay? Clear? If a closeness of security is high, then beta will also be what? High. Sensitivity will be high. Yes or no? If closeness is high, then what? Sensitivity will be high. Yes or no? Closeness is high. That is applicable to relation also. If they are close, what? Sensitivity will be high. Responsiveness will be high. Next, the portfolio beta is nothing but what? Weighted average of a security beta. So beta of a portfolio is equal to beta A. So WA beta A plus WB beta B. So beta of a portfolio is simple. Weighted average of a security beta. WA beta A plus WB beta B. Clear? So you should know the columns, main important. Beta. First step in beta calculation is you should find out sigma m square. Generally more than 2 years data will be given. Of course in question 2 periods data can also be given. But generally more than 2 years data will be given. First step we should find out sigma m square. When past data is given, what are the columns for sigma m square? M, m bar, m minus m bar, m minus m bar whole square. When more than, okay, when probability is given, then what are the columns? M, P, P into M, m bar, m minus m bar, P into m minus m bar whole square. Next, covariance of security and market. Covariance of security and market means co-movement of security and market. Okay, here we cannot directly take S minus S bar, M minus M bar, S minus S bar into M minus M bar. We cannot directly take because we need S bar. We are not finding out sigma S, standard deviation of security. Okay, so that's why here the columns for covariance of S comma M is S, S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. The future data, when future data is given, be careful. When probability is given, what are the columns? S, P, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. S, P, P into S, S bar, we need S bar. So, covariance of S comma M means deviation of security into deviation of a market. So that's why these are the columns we should take. So first step sigma m square, because in sigma m square we can find out what M minus M bar. So this is the first step. So this is how the beta is calculated. So next practice question is question number 10. Question number 10. Why this question is for practice? Because the reason is, compute the beta value of a Krishna Limited at the end of a 2015 and state your observation. State your observation. They're asking you to compute beta value, and also what they are asking you to state your observation. So you might forget the observation in examination. So that's why this question is for what? Practice. Okay. So what is the first step to find out the beta? Sigma m square. And next step, covariance of S comma m. So tell me in this question, probability is given or not? Probability is not given. So that's why tell me the columns. Sigma m square columns, m bar, m minus m bar whole square. So but here in this question, the special point is calculation of a m. M is not given in the question. We have to find out m. Average market index is given. We should find out m. How we are going to find out m? M is equal to P1 minus P0 plus D1 divided by P0. What is P1? 2130 minus 2013 divided by 2013 plus 5%. We should take 5% separately because the reason is dividend amount is not given for the market. Dividend yield is given. Dividend yield is nothing but D1 by P0. Already it was divided by P0. So that's why we should take what? 2130 minus 2013 divided by 2013 plus 0.05. Clear? But whereas for security, dividend amount is given. If you see the security, Krishna Limited dividend amount is given. So what is the calculation? 253 minus 245 plus 22 divided by 245. Clear? So in this question, the special point is calculation of m, calculation of a s, and also state your observation. State your observation. What is observation? Here for us, Government of India bond is also given. Written on a Government of India bond. So nothing but that is RF. That is RF. M bar is nothing but RM. M bar is nothing but what? RM. So RF, RM and beta is there. So we can find out what? CAPM return. How do we get CAPM return? RF plus RM minus RF into beta. Okay. So in portfolio management, we have a concept of underpricing and overpricing. How we decide whether the security is underpriced or overpriced? How we compare? CAPM return is equal to RF plus RM minus RF into beta. For suppose if beta is equal to 0, CAPM return is equal to RF. If a beta is equal to 1, then RF will get cancelled. So CAPM return is equal to RM. If a beta is equal to 2, then RF plus RM minus RF into 2. Nothing but if beta increases, CAPM return will also increase. So how we decide whether the security is underpriced or overpriced? By comparing the actual return and CAPM return. For suppose if actual return is greater than CAPM return is nothing but required return. Required return. For suppose CAPM return is equal to 15%. I require 15%. But the actual return of a security is 20. Actual return of security is 20. So that means security is underpriced. Security is underpriced. I want only 15, but security is giving 20. I should buy the security or not? Yes, I should buy the security because I'm getting security is giving return more than my requirement. I should buy means when I'm going to buy if security is underpriced. Okay. If actual return is less than CAPM. For suppose if security is giving only 10%, then I'm not going to buy. If I have a security, I will sell it. Because security is giving less than my requirement. So if actual return is less than CAPM return, it is overpriced. So this is frequently asked concept. Okay, we have to sell the security. If actual return is equal to CAPM, it is correctly valued, hold it. Hold the security. If you are getting confused, better you find out Jenson's alpha. Jenson's alpha is equal to actual return minus CAPM return. If Jenson's alpha is positive, buy the security. If Jenson's alpha is negative, sell the security. If Jenson's alpha is equal to 0, hold the security. We can find out Jenson's alpha and decide whether to buy, hold or sell. Or else you can compare actual return and CAPM return and can decide whether to buy or sell. But better you find out Jenson's alpha, because I have seen one certified copy. In that certified copy, student has compared actual return and CAPM return and he wrote the answer buy or sell. But marks were not given because in suggested answer, Jenson's alpha was calculated. So that's why. Clear? Okay. And the other way of deciding whether to buy, hold or sell, compare the actual market price and CAPM market price. CAPM market price. For suppose market price is different. If actual market price is greater than CAPM, theoretical market price. For suppose if actual market price is 120, CAPM price is only 100. Overpriced. Buy or sell? Sell. Because it is overpriced. If actual market price is less than CAPM, underpriced. Buy or sell? Buy. If actual market price is less than CAPM, underpriced, so buy. If both are same, if actual market price and CAPM, it is also called as equilibrium price. CAPM price is also known as equilibrium price. If both are same, then what? Hold. So in this question, the special point is they are asking you to state your observation. State your observation is nothing but what? Actual return minus, nothing but we should compare actual return and CAPM return, and we should say whether it is overpriced, underpriced or hold, correctly valued. In 1213 it is overpriced because CAPM return is greater than, so actual return is less than CAPM, so it is overpriced. In 1314 it is underpriced. In 1415 it is overpriced. So this is the special point in this question. High chances of forgetting this. State your observation. Okay. Now I'm giving 10 minutes time to calculate this question. You have to practice this question. You have to practice this question. High chances of doing a mistake. Question number 10. You have to practice this question. Question number 10, practice. This is the third practice question in portfolio management. If completely new question is asked to Shiva, then definitely nobody will be able to answer. But you have to focus on the known questions. Out of 7, definitely 5 questions you will be knowing. In this in this class, I'm going to cover all the points. That is levered beta, unlevered beta, risk utility, risk penalty, the concept which is required to answer descriptive as well as MCQs. Done. You have to state your observation as well. Calculating beta itself is not enough. Pravalika, very good, Amma. CR. M. Pravalika. साहिल वेरी गुड. इस बार SFM को भगाएंगे. Anybody in class completed? I cannot send apples to online students, okay? They have completed, online students have completed the answer. Offline, face to face, Babu, Varun, second Varun. Huh? Pravalika ka? Okay, let us consider Pravalika as offline student. Shivani, what about you? Completed. Manasa? Clear? Shileka, you completed. So who completed first in face-to-face class? Shivani, Shileka, na Manasana. There are other apples also. Tell me. Varuna. There are other practice questions. Shivani, you. Okay. Shileka, give this apple to Shivani. So thought of to give chocolates, but health will get affected, right? So that's why an apple keeps the doctor away. Done. Next, question number 11. Question number 11. So that question I am going to discuss in derivatives chapter. Question number 11. Now not required. Question number 12. Question number 12. It is a referral question. You have to refer that to third part. I'm just directly explaining the third part. Okay, you can pause the video and read the question later on. If the expected return of a market portfolio is 12% at a beta factor of 1, what will be the portfolio expected return in both the situations given above? Question number 12, third part is the referral part, because the reason is generally expected return of a portfolio. How do we get expected return of a portfolio? RF plus RM minus RF into beta. But in this question, RF is not given. So that's why, how do we get expected return? Simply beta into RM. Beta into RM. What is beta? 1. RM is equal to 12%. So, sorry, beta factor. What is beta? First case 1.22. So 1.22 into 12%. Second case 1.335 into 12%. First and second part self-explanatory, you can understand easily. So third part, referral point. So instead of doing RF plus RM minus RF into beta, we are simply what? Multiplying beta with RM. Clear? And expected return of a market portfolio 12% at a beta factor 1. At a beta factor 1 means what? Beta of a market is always what? 1. For beta factor 1, the return is 12%. So for 1.22, the return is equal to 1.22 into what? 12%. So 12th question is for referral. 13th question is also for referral. A plus category. 13th question is for referral. Here we should assume the beta of a debt as 0. Beta of a debt as 0. So they are asking you to find out what? Question number 13. What is the beta of a company's existing portfolio of asset? Company's existing beta. Beta of a company's existing portfolio of asset. So we have a equity and debt in the portfolio. Equity 60 lakhs, debt 40 lakhs. Here the special point is you would assume that the beta of a debt is equal to 0. How do we get beta of a company? By doing a weighted average. So what are the weights? 60 lakhs divided by 1 crore into 1.5 plus 40 lakhs divided by 1 crore into 0, that is equal to 0.9. Clear? The next part of the question, calculate the company's cost of a capital. How do we get company's cost of a capital? By doing a weighted average of KE and KO. KE and KO. How do we get KE? KE is equal to RF plus RM minus RF into beta. In this question, RF is given directly 8% and market risk premium is given. Market risk premium means nothing but RM minus RF. Market risk premium is equal to RM minus RF. Security risk premium is equal to RM minus RF into beta. So cost of equity is equal to 8 plus 10 into 1.5, 23%. Weighted average cost of a capital is equal to 23 into 60 lakhs divided by 1 crore plus. Here cost of a debt, again we are assuming risk-free rate as a cost of a debt. Treasury bill rate is given. What is the treasury bill rate? 8%. That 8% is being assumed as what? Cost of a debt. Okay. So 23% into 60 lakhs divided by 1 crore plus 8% into 40 lakhs divided by 1 crore. So the answer is 17%. So the overall cost of a capital is 17. So the other alternative to find out KO is risk-free rate 8 plus risk premium into overall beta. What is overall beta? 0.9. In both the cases, you will get a 17. And one theory question is there in this. Compute cost of a capital and also the discount rate for an expansion of the company's present business. Okay. If a company wants to expand the present business, what is the discount rate? Simple. If a company wants to expand its own, present business, then the cost of a capital is same cost of a capital. But if it is going to diversify, then what? Different discount rate will be used. Different discount rate will be used. This question is for referral. The points to be noted is what? Beta of a debt is equal to 0. Cost of a debt is equal to risk-free rate. Clear? Next, 14th question, A++. This question you have to practice. 14th question. 14th question you have to practice. Yes, Pranav. For theory questions, correct side heading and related theory is enough. Okay. Question number 14 is for practice. A Limited has an expected return of 22% and standard deviation of 40%. B Limited has an expected return of 24%, standard deviation of 38%. A Limited has a beta of 0.86 and B Limited has a beta of 1.24. The correlation coefficient between the return of A Limited and B Limited is 0.72. Correlation coefficient between A and B is 0.72. What is the meaning of this, Pramada? 0.72. Securities are moving in same direction but not in same proportion. The standard deviation of the market return, sigma m is equal to 20. Suggest first part. Is investing in B Limited better than investing in B Limited? Is investing in B Limited is better than investing in A Limited? Yes or no? Yes, investing in B Limited is better than investing in A Limited because B Limited is giving return 24, A Limited is giving 22. So B Limited risk is 38, A Limited risk is 40. Investing in B Limited is better than investing in A Limited because B Limited is giving high return for low risk. So first part you need not practice, simple. Second part, if you invest 30% in B Limited and 70% in A Limited, weights are given. What is your expected rate of a return and portfolio standard deviation? They are asking you to find out the expected rate of a return and portfolio standard deviation. Simple. How do we get expected return of a portfolio? By doing weighted average of a security return. Security returns are given. Weights are given. We can find out P bar. Next, portfolio standard deviation. correlation coefficient sigma xy is also given. So sigma p. So what is the formula we have to apply for sigma p? Sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. So this is the formula you have to apply. So second part also you can refer, but third point, so that is the special point in this question. What is the market portfolio expected rate of a return? What is the market portfolio expected rate of a return? Market portfolio expected rate of a return means they are asking you to find out RM and how much is the risk free rate, RF. They are asking you to find out RM and RF. How can we find out RM and RF? So you have to form an equation. Okay, from company to company, beta will be changing, but RM and RF will remain same. For A limited and B limited, RM will be same and RF will also be same. So third part, you should know how to form the equation. So the equation is equal to, what is the expected return of A limited? 22. So 22% is equal to RF plus RM minus RF into 0.86. Beta of A limited is given. So that is the equation number 1. Next, RF plus, next 24 is equal to RF plus RM minus RF into 1.24. Equation number 2. Equation 1 minus 2 or equation 2 minus 1. RF will get cancelled and you can find out what? Okay, RM and also what? RF. So third part. Next, fourth part. What is the beta of a portfolio of A limited? What is the beta of a portfolio? If A limited's weight is 70 and B limited weight is 30. Simple, by doing a weighted average. We can do a weighted average. So this question can be solved within 7 minutes, 6 to 7 minutes. Solve this question. If you know the answer, then try to solve as soon as possible. So clear? So question number 15. So we are going to discuss in security valuation chapter. So that is a simple question. Next, question number 16. It comes under A plus category. That means you have to refer question number. So question number 15. We are going to discuss in security valuation. Question number 16. So this comes under A plus category. That means you have to refer. You have to just refer this question. Simple question. Energy trained, Mahima Singh. Mr. Tempest has the following portfolio of a 4 shares. Determine the portfolio return and calculate the portfolio beta. Simple. How do we get portfolio beta? Portfolio beta simple, weighted average. By doing weighted average, we can find out what portfolio beta. And then how can we get portfolio return? RF plus RM minus RF into beta. RF is given in the second sentence, 7%. RM is also given, 14. So portfolio return is equal to RF 7 plus RM 14 minus 7 into beta. So simple question, just refer. And next 17. Next 17. 17th question also you have to refer. You have to just refer this question. Okay. Equilibrium return is given, market return is also given. Equilibrium return is also called as CAPM return. CAPM return. CAPM return is equal to 15. Market return is also 15. If you know the concept, then you can estimate the beta. What is beta? Beta is equal to 1. Because market return and CAPM return are same, means beta is equal to 1. 7% treasury bond trading at $140. Covariance of market and security 225. Coefficient of a correlation 0.75. You are required to determine the standard deviation of market return and security return. Okay. You are required to determine the standard deviation of a market return, sigma m and sigma s. So first we should find out beta. So beta is equal to what? 1. Straight away we can say beta is equal to 1 because equilibrium return and CAPM return are same. Okay. Next what? Beta is equal to 1. What is the formula for beta? Covariance of S comma m sigma m square. Covariance of security and market is given in the question. So we can find out sigma m square. So square root of sigma m square is nothing but standard deviation of a market. And next what? By applying beta third formula. What is the beta third formula? Sigma sm into sigma s divided by sigma m. So sigma sm is also given in the question. Correlation coefficient. We know sigma m. So we know beta. We can find out what? Sigma s, standard deviation of a security. So 17th question, simple. So this comes under refer category. Next, 18th question. 18th also A plus category. You are required to determine. Okay, you feel like leaving the class, but writing exams in June is even more difficult, okay? So better you stay. Energy will get drained, that is obvious. Okay? So even my energy is also getting drained, but I don't want to see your face again. So question number 18. Okay, question number 18. Mr. Fed Up, I want to see your face, but in a different place. Like in metro, pub, airport. Okay, not in class. Mr. Fed Up wants to invest an amount of rupees 520 lakhs and had approached his portfolio manager. The portfolio manager had advised Mr. Fed Up to invest in the following manner. So amount is given, beta is given. You are required to advise Mr. Fed Up in regard to the following using CAPM. Why I am asking to refer this question? Because the reason is this question is simple question only. But when the text changes, moderate, better, good, instead of giving XYZ, you feel like this is a new question. But this is a normal question only. They are asking you to find out the CAPM return. How do we get CAPM return? RF plus RM minus RF into beta. Nifty is yielding 10%. Nifty means market. RM 10%, RF 8. So by doing weighted average, we can find out what? Beta. So CAPM return is equal to RF plus RM minus RF into beta. Clearer? But in this question, the point to be referred is advisability of replacing security better with Nifty. Advisability of replacing security better with Nifty. So even if you replace security better with Nifty, so it is not going to affect, no difference. It will not make any difference because the reason is better beta is 1, Nifty beta is also 1. Nifty means market beta is also 1. Better beta is also 1. Even if you replace better with Nifty, it will not make any difference. You will get same portfolio beta and same CAPM return. So 18, refer. 19, refer because the reason is 19, you have to remember the point. Even though you know the concept, you will not be able to do this question because you have to remember one point. Your client is holding the following securities: gold, silver, bronze, government of India bond, cost, dividend or interest, market price. Beta is given. Average return of the portfolio is 15.7%. Calculate expected rate of a return in each using CAPM. In each case, we should find out what CAPM return. And also what we should find out risk-free rate of a return. Risk-free rate of a return. We should find out what expected rate of a return in each using CAPM. How do we get CAPM? RF plus Rm minus Rf into beta. In question, Rf is not given. Rm also not given. Rf is not given in the question. And also what? RF is also not given in the question. This question is a referral question because the reason is here we are going to find out portfolio return. We are going to find out what? Portfolio return. See the cost. What is the cost at the beginning? 75,000. What is the market price at the end? 80,500. What is the overall dividend? 7,025. So market return is equal to 80,500 minus 75,000 plus 7025 divided by 75,000. Actually, this is portfolio return. This is a portfolio return, but we are assuming this portfolio return as what? RM, because there is no scope to find out RM and RF. Unless we take this assumption, we cannot find out RM and RF. So that's why what? Even though it is a portfolio return, we are assuming this as what? RM. What is RM here? 16.7. And next we are finding out the portfolio beta. How do we get portfolio beta? By doing a weighted average proportion into beta. Now, in the question, average return of portfolio 15.7 is given. That 15.7 is assumed as a CAPM return. The 15.7 which is given in the question is assumed as what? CAPM return. So 15.7 CAPM is equal to RF. We do not have a RF plus RM 16.7. The portfolio return which we calculated is assumed as what? RM. So 15.7 is equal to RF plus 16.7 minus RF into beta 0.3568. So RF we are getting 15.15 risk-free rate. Now we can find out what CAPM return each case. In each case, how can we get CAPM return? RF plus RM minus RF into beta. So the special point in this question is what? We are assuming the portfolio return as what? RM, market return. Clear? Now come to question number 20. This is also a referral question. So this is also a referral question. 4 securities are given. Cost, market price. Cost at the beginning, market price at the end. Beta is given. Risk-free rate is this given. This is similar to 19 but not exactly same. Because in question number 20, risk-free rate is given. They are asking you to find out expected rate of a return in each using CAPM. How do we get CAPM? RF plus RM minus RF into beta. And also what they are asking you to find out simple average return of a portfolio. So for first part we require what? RM. How do we get RM? Again same. We find out the portfolio return. P1 minus P0 plus D1 divided by P0. 15.88%. This 15.88% is assumed as what? RM. Actually it is portfolio return, but assumed as what? RM. Clear? So in each case, RF is given in the question, RF plus RM minus RF into beta. And second part of the question is they are asking you to find out the simple average rate of a return. How do we get simple average rate of return? By doing a simple average of all the 4 securities returns. Done? So question number 20 is for referral. Question number 21, we are going to discuss in security valuation. That is a simple question. 21 is a simple question. Okay, CA final. In last 4 attempts of a CA final, they have asked 2 times. Question number 21. So chance is there that they may ask this question in CMA final. Because in CMA final, they are asking CA final past questions and what? CA final study material questions. And next question number 22. Question number 22 comes under A++ category. You have to practice this question. A++. Practice this question. Get ready. You have to practice this question. Question number 22. I will explain first, then once after explanation, You have to practice. Pause the video and practice this question. An investor holds two stocks, A and B. An analyst prepared ex-ante probability distribution for the possible economic scenarios. Ex-ante means future. Ex-ante probability distribution for the possible economic scenarios and the conditional returns for two stocks and the market index as shown below. Conditional returns percentage A, B and market. Economic scenario probability. So there are three possibilities. Economic scenario growth, stagnation, recession. Probability 0.4, 0.3, 0.3. Conditional returns A, B and market are given. Nothing but A, B and M are given. A, B and M are given. The risk-free rate during the next year is expected to be around 11%. RF is also given. RF. Determine whether investor should liquidate his holdings in stock A and B or on the contrary, make fresh investment in them. CAPM assumptions are holding true. First you should understand the question. The question is determine whether the investor should liquidate, investor should sell, or on the contrary, on the opposite side, make investment. So this question is simple. The language is a little complicated. Liquidate or contrary, make fresh investment. Question is simple. You have to determine whether the company, investor should buy or sell the shares. Buy or sell the shares. How do we decide whether the shares should be sold or bought? By calculating the Jenson's alpha. If Jenson's alpha is positive, buy. If Jenson's alpha is negative, sell. How do we get Jenson's alpha? CAPM return minus actual return minus CAPM return. Actual return minus CAPM return. How do we get CAPM return? RF plus RM minus RF into beta. So actual return of security minus CAPM return of a security. Actual return of a security means nothing but S bar. A bar. How do we get CAPM return? RF plus, RF is already given. RF plus RM. We have to find out. RM is nothing but M bar minus RF into beta. We need beta also. We should find out beta for what? A and B. Okay. Clear? RF and RM will be constant. So beta of A we have to find out. Beta of a B we have to find out. Okay. So what is the first step to find out beta? Sigma M square. Sigma M square. First we should find out sigma M square. Here there is a probability. Here we have a probability. So tell me the columns. M, P, P into M, M bar, M minus M bar, P into M minus M bar whole square. Next what? Covariance of A comma B. Sorry, A comma M. Covariance of A comma M. So tell me the columns for covariance of A comma M. A, P, P into A bar, A minus A bar, M minus M bar, P into A minus A bar into M minus M bar. Next you have to find out what covariance of B comma M. Covariance of B comma M columns. B, P, P into B, B bar, B minus B bar, M minus M bar, P into B minus B bar into M minus M bar. You have to find out, and then we can find out what beta of A, beta of a B, and then what we can find out Jenson's alpha. So first you should understand the question. Question number 22 is for practice. So now you can pause the video and okay, try to solve this question within 13.65 minutes. 13.65 minutes. You have to practice. 22. Purani from Tamil Nadu. Aditya from Jharkhand. Any married students? Oh, Bharat sir came with apple, but nobody. Anybody completed or not? Pandu, another Pandu. Shahjahan. Again, that Pandu only, Vishnu. So, Pandu, in felicitation program, you have to mention this. Yeah, on stage. Srilekha, Pramada, Priya. So, beta is equal to 1.351 times. Buy both the securities. Buy both the beta of a and beta of a B. Okay. What is the beta of A? Beta of A is equal to? Very good, Mahima and Sahil. Both are undervalued, right? Both the securities are undervalued. Suresh, Bobbili. I have a friend from Bobbili, Shyam, CMA, qualified CMA, working in BSNL. Huh? Meedi Bobbili na, okay. Here I have a Krishna Mohan, he is also from Bobbili. Meet online student Suresh Matsa. Clear? I have a friend from Jharkhand, Bhavamitra, he is working in NTPC right now in Assam. Clear? Everybody completed question number 22. Jenson's alpha, GENSEN. Both the securities are undervalued because Jenson's alpha of both the securities is positive. Okay. Next question number 23. Next concept, arbitrage pricing theory. Arbitrage pricing theory. Next concept, arbitrage pricing theory. I'm moving on to the next concept, Pramada. Huh? Clarity leda? What about this question? So this is actually image created, so that's why. See the arbitrage pricing theory. Arbitrage pricing theory. So arbitrage pricing theory is simple. So you know the CAPM return, right? So what is the CAPM return? CAPM return is equal to RF plus RM minus RF into beta. CAPM return is equal to RF plus RM minus RF into beta. Next question, question number 23. Question number 23 is for referral. Okay. So arbitrage pricing theory, next concept. Arbitrage pricing theory, required return is equal to RF plus factor 1 beta 1 plus factor 2 beta 2 and so on. Here the factor 1 means risk premium for factor 1. Risk premium. F1 means nothing but what? Risk premium for factor 1. F2 means risk premium for factor 2. Risk premium for factor 2. Okay. CR Pravalika कहाँ गायब हो गया? Pravalika, you're not saying an answer. Okay. So arbitrage pricing theory. Arbitrage pricing theory is simple. CAPM return is equal to RF plus RM minus RF into beta. What is the beta? Beta denotes sensitivity of a security return with respect to change in market. Yes or no? But the market is affected by several factors like GDP, interest rate, inflation, industrial production, etc. There are several factors which will influence the market, and not every factor is going to affect the market in the same manner, in the same, okay, with the same effect, right? So that's why arbitrage pricing theory is arbitrage pricing theory. Varsha, Sahil told your Hindi is great. My Hindi. Small biscuit, okay. So arbitrage pricing theory, RF plus F1 beta 1. Why we are taking F1 beta 1 plus F2 beta 2? Because the reason is market is affected by various factors like GNP, interest, inflation, industrial production, etc. So that's why here in arbitrage pricing theory, instead of considering one single premium for the factor overall market, we are going to consider what? Premium for each factor separately. Premium for each factor separately. Okay, arbitrage pricing theory is simple. So we are going to consider premium for each factor which is affecting the security return separately. So that's why what? RF plus F1 beta 1, F2 beta 2, and so on. So this is arbitrage pricing theory, and Jenson's alpha is equal to what? Actual return minus CAPM return. And if Jenson's alpha is positive, buy the security. If it is negative, sell the security. If it is zero, hold the security. Okay. Now let us refer what to question number 23. So question number 23 is simple. Mr. Tamarind intends to invest in equity shares of a company, the value of which depends upon various parameters as mentioned below. Factor beta, expected value in percentage, actual value in percentage, GNP, inflation, interest rate, stock market index, industrial production. So total 5 factors are given, and 5 factors sensitivity is given. Varun, 5 factors sensitivity is also given. Okay. If the risk-free rate of interest is 9.25%, how much is the return of the share under arbitrage pricing theory? How much is the return under arbitrage pricing theory? Under arbitrage pricing theory, so return is equal to RF plus F1 beta 1 plus F2 beta 2 plus F3 beta 3 and so on. Clear? So here how many factors are given? Total 5 factors are given. 5 factors betas are given, and premium is not given. In this question, the special point is premium is equal to actual value minus expected value. So this point you have to remember. Even though you know the concept, you have to remember this point. You have to retain this point. Actual value minus what? Expected value is the premium. So the answer is simple. So first case, what is the premium? Premium 0 into beta. 0. Very good, Amma. Triveni. But you will not get apple. So next, 1.75 into 1.5, 1.3 into 1.25, 1.7 into 2, 1 into 0.5. Total 8.15 plus risk-free rate. So the answer is what? 17.4%. 17.4%. Clear? Okay, done. So next, 24. 24 is also referral question. You have to refer this question, 24. Why this 24 question you have to refer? Because the reason is because the language is small cap, large cap. By seeing this text, you might get panicked. So that's why what you have to refer this question. Question number 24. Mr. Nirmal Kumar has categorized all the available stock in the market into the following types: small cap growth stock, small cap value stock, large cap growth stock, large cap value stock. Mr. Nirmal Kumar also estimated the weights of the above categories of a stock in the market index. Furthermore, the sensitivity of a return on these categories of a stocks to the three important factors are estimated to be. Three important factors, a sensitivity is given. Categories of a stocks: small cap growth, small cap value, large cap growth, large cap value. Weight in the market index: factor 1 beta, factor 2 beta, factor 3 beta. And also risk premium is given for each factor separately. Risk premium for each factor is given separately. Risk premium for each factor is given separately. Why I am repeating? Because next you have to practice an additional question. In that additional question, risk premium is not given separately. That's why. Okay. So you should know the difference between this question and next question which you are going to practice. The rate of a return on treasury bond is 4.5% required. Using arbitrage pricing theory, determine expected return on the market index. You have to determine what? Expected return on the market index. Using arbitrage pricing theory. How can we find out the expected return using the expected return on market index using APT? RF plus F1 beta 1 plus F2 beta 2 plus F3 beta 3. They are asking you to find out the expected return on market index. Market is containing 4 securities. 4 securities. Okay. So first we should find out the portfolio beta of a factor 1. How do we get portfolio beta of a factor 1? By doing weighted average. By doing weighted average of the portfolio beta, you will get 1. And next portfolio beta 2, 2.105. Portfolio beta 3, 5.8. Weights are given. Weights of 4 securities are given. Betas are also given by doing weighted average. Clearer? Next expected return is equal to RF 4.5 plus F1 6.85 into beta 1 plus F2 2.105 into beta 2 plus F3 beta 3. So answer is 7.7525. So this is the answer for expected return on a market index. First part. Clear? Or else you can find out what arbitrage pricing theory expected return for each security. You can find out what each security return under APT and then do what weighted average. Find out the expected return of each security and then do what weighted average. So then also you will get the same answer, 7.7525. Next. Second part, using CAPM, determine the expected return on the market index. Using CAPM, determine the expected return on the market index. CAPM means simple. CAPM means what? RF plus RM minus RF into beta. Nothing but we will be considering only what? First beta, factor 1 beta. We are going to consider only what? Factor 1 beta. Factor 1 beta. Clear? So what is the answer? 11.35. Next. Third part. Third part is simple, but question is lengthy. Mr. Nirmal Kumar wants to construct a portfolio constituting only small cap value. Only what? Small cap value and large cap growth. Only 2 securities, small cap value and large cap growth. If the target beta for the desired portfolio is 1, if the target for the desired portfolio is 1, determine the composition of his portfolio. What is the target beta? 1. Target beta is equal to 1. Target beta is equal to 1. So they are asking you to find out the composition, proportions. They are asking you to find out the proportion. Let the proportion of small cap value is equal to P. Then the proportion of large cap value is equal to 1 minus P. Yes or no? So what is the beta of a small cap value? 0.9. So P into 0.9 plus 1 minus P into 1.165 is equal to what? 1. So P is equal to 0.6226, nothing but 62.26. 1 minus P is equal to 37.74. Nothing but small cap value proportion is equal to 62.26 and large cap growth is 37.74. Clear? Done. But now you have to find out, you have to practice this additional question number 6. Additional question number 6 is the CA final past examination question. CA final past examination question. This you have to practice. So this is not factory, this is factor actually. On the screen you will find factory. This is factor. Okay. This is not a factory or any shopping mall, okay? This is factor. Factor 1, factor 2. So additional question number 6, you have to practice this question. This is CA final past question. Extreme case. I considered extreme case and included this question. Additional question number 6. Additional question number 6. So this is not the same question. An investor has categorized all the available stock in the market into following types. The estimated weights of the categories of stocks in the market index are given below. Further, the sensitivity of returns on these categories of stocks to two factors, inflation and stock market, are also given below. 2 factors are given. Not the 3 factors, only 2 factors. Factor 1 inflation, factor 2 stock market. CAPM means we consider only what? Stock market. We consider only what? Stock market. Clear? Okay. Small cap weight in market index 20, mid cap 30, large cap 1.3, flexi cap 1.7. Beta, factor 1 beta is given, factor 2 beta is given. Risk-free rate of interest is 7.5, round off to 2 decimal. You are required to calculate expected return on the market index of the both the factors. Expected return on the market index for both the factors. For both the factors, we should find out the expected return. So what is the difference between the previous question and this question? In previous question, premium is directly given for factor 1 and factor 2. But here, not given. So this is a mix of question number 23 and 24. So here, how to find out the premium? Actual return minus expected. Actual value minus expected value. And one more difference between the previous question and this question is, in the previous question, premium for all the securities is same. Premium for all the securities 6.85 something is given for all the securities for factor 1. But here, if you observe this question, the premium is not same for all the securities. You are required to calculate expected return on the market index for both the factors and also what? Expected return on the market index under arbitrage pricing theory Expected return on the market index under arbitrage pricing theory if the composition of portfolio is changed to 25% equal in all 4 categories. Which alternative existing or changed will be more profitable? Which alternative will be more profitable? So will you be able to practice this question? Okay. Expected return on a market index. Expected return on a market index. What are the weights? 0.2. What is the expected value? 6.7. So 0.2 into 6.7 plus 0.3 into 4.5 plus 0.15 into 6.75 plus 0.35 into 7. So this is the expected return for factor 1. And they are asking you to find out what factor 2 also. How do we get for factor 2? 0.2 into 10. This question is different from the previous question. 0.2 into 10 plus 0.3 into 7 plus 0.15 into 9 plus 0.35 into 8.85. So answer is 8.55. Next, expected return on the market index under arbitrage pricing theory. Here we cannot find out directly the weighted beta. We should find out what? Expected return on. We have to find out what? Expected return for each security. For each security, we should find out what? Expected return. Clear? How do we get RF plus F1 beta 1 plus F2 beta 2? Clear? Likewise, we should find out for what? Each security. And then what? Multiply with the weight. Here the presentation is little complicated, but you can find out on your own. Simple. RF plus beta 1 F1. RF plus beta 1 F1 means what? What is RF here? 7.5 plus what is beta 1? 1.2 into 0. Because what is the premium under factor 1? Premium for factor 1 is 0. So that's why RF 7.5 plus 1.2 into 0 plus 0.8 into 0.5. 0.8 into 0.5. How we got 0.5? Actual return minus expected value. Premium is equal to actual return minus expected value. Clear? Likewise, we should find out expected return under arbitrage pricing theory for all the 4 securities and then do what? Weighted average. In C part, what? We are changing the weights. Instead of 20, 30, 15 and 35, weights are 25%. So question number 6. Practice this question. Complete this question within next 10-15 minutes. Second part, in the question bank or a solution sheet, answer is complicated. So that's why I'm telling you the answer. Second part, how to calculate it. You should find out the arbitrage pricing theory return for each security separately. RF plus F1 beta 1 plus F2 beta 2. So find out for all the 4 securities and then do what? Weighted average. So 15 minutes time. 7:20 is the time. By 7:35 complete this question. You have to complete this question. Online students, after completing this question, you can have your dinner while explaining theory. While I explain the next concept, you can have a dinner, okay? Question number 25. Question number 25, main question. It is for practice. After question number 25, dinner break for offline students. 15 to 20 minutes. Half an hour. SFM को भगाना है ना, तो भागो. SFM. Okay, question number 25. Question number 25. So this question is for practice. Question number 25. Mr. X owns a portfolio with the following characteristics. Mr. X owns a portfolio with the following characteristics. Security A, security B, risk-free securities. This question is for practice. Okay, first part is complicated. Second is even more complicated. Third, okay, it is a hell. Third part. So even if you do 1 and 2, so okay, 99% you may not be able to do what? Third part. Okay, so be careful. Question number 25. Mr. X owns a portfolio with the following characteristics. Security A, security B, risk-free securities. Factor 1 sensitivity, factor 2 sensitivity, expected return are given. It is assumed that security returns are generated by two-factor model. First part of the question. If Mr. X has rupees 1 lakh to invest and sells short rupees 50,000 of security B and purchases rupees 1,50,000 of security A, what is the sensitivity of a Mr. X portfolio to the two factors? So what is the sensitivity of a Mr. X portfolio to the two factors? Mr. X has rupees 1 lakh to invest. Mr. X is having only 1 lakh to invest. What he is actually doing? Sells a short rupees 50,000 of a security B. Short selling means what? Selling a security without having it. Instead of buying, he is selling the security B. Already he is having 1 lakh. 1 lakh plus on short sale of a security B, he will receive 50,000. Overall, 1 lakh 50. Purchases rupees 1,50,000 of a security A. So that means what is his portfolio? A 1,50,000 purchase, B 50,000 sale. Risk-free security. He is not purchasing or selling risk-free security. So factor 1. Okay, factor 1 sensitivity. So they are asking the portfolio sensitivity. How do we get portfolio sensitivity? Portfolio sensitivity is equal to weighted average of security sensitivity. Weighted average of security sensitivity. So first case, what is the weight of a security A? 1.5. Because with 1 lakh we invested 1,50,000. So 1.5 into factor 1 sensitivity of a security A 0.8 plus security B weight minus 0.5 into 1.5. So 0.45 is the answer. Likewise factor 2. Okay, so first part, so this chart weight, determining the weight is the special point. See the second part of the question. If Mr. X borrows rupees 1 lakh at the risk-free rate and invest the amount he borrows along with the original amount of rupees 1 lakh in security A and B in the same proportion as described in 1, what is the sensitivity of a portfolio to the two factors? Mr. X borrows rupees 1 lakh at risk-free rate and invests the amount he borrows along with the original amount of rupees 1 lakh. Already he is having 1 lakh. And Mr. X borrows 1 lakh at risk-free rate. He is not investing in risk-free security. He is borrowing. He is borrowing. Already he is having 1 lakh, right? Okay. And investing in security and A and B, investing in security A and B in the same proportion as described in part 1. Simple. Second part. So risk-free borrowing is being made. Risk-free borrowing. What is the risk-free borrowing here? 1 lakh. Okay, 1 lakh plus original amount, 2 lakhs. So this 2 lakhs is invested in A and B in the same proportion as described in part 1. In part 1, so when we have a 1 lakh amount, short selling 50,000 rupees for security B, yes or no? Now I have a 2 lakhs. So when I have 2 lakhs, I will do short selling of 1 lakh. So already I'm having original amount 1 lakh, risk-free borrowing 1 lakh, short selling of security B 1 lakh, overall 3 lakhs invested in security A. So when I have just 1 lakh, I invested 1 lakh 50 in security A. Now I have 2 lakhs. So that's why I will invest 3 lakhs in security A. Clear? So now the weights for second case is 3 minus 1 minus 1. What are the weights? 3 minus 1 minus 1. So what is the sensitivity of risk-free security? Sensitivity of risk-free security is equal to 0. You know that beta of risk-free security is equal to 0. Responsiveness of risk-free security is equal to 0. Okay. So we have to find out what sensitivity of factor 1 and factor 2. Clear? Last part is more critical, complicated part. What is the expected return premium of factor 2? Expected return premium of factor 2 means we should find out what F2. We should find out F2. How can we find out F2? So we should form an equation. We should form an equation. What is the equation? Here the expected return is given 15. So let us assume this 15% is the return under arbitrage pricing theory. Return under arbitrage pricing theory. So how do we get this 15? 15% is equal to RF 10%. RF 10%. Risk-free return is equal to 10%. RF 10% plus F1 beta 1. We don't know F1, but we know beta 1 0.8 plus F2. We don't know F2, but we know beta 2. Beta 2.6. So the equation is 15% is equal to 10% plus F1.8 plus F2.6. Likewise, we form another equation. What is another equation? 20% is equal to 10% plus 1.5 F1 plus 1.2 F2. 1.2 F2. By solving equation 1 and 2, we can find out what F1. So 99% chance you may not be able to do this question now. Okay. Or next time when you write the next grand test also, when you try on your own, you may not be able to do the third part. So this is the past examination. In every question is a past examination question in portfolio. Every question. Okay. So 15 minutes time, 13 point. So clear? So 25th question is for what? Practice. 26th. You need not refer. 26th question you need not refer, but let us see the concept. So 26th question you need not refer, but let us see the concept. Simple. Sharpe ratio. Sharpe ratio is equal to RP minus RF divided by sigma P. It denotes excess return per unit of total risk. Excess return per unit of total risk. Okay. Treynor's ratio. RP minus RF divided by beta P. It denotes excess return per unit of systematic risk. You may get confused. Be careful. Sharpe ratio, Treynor's ratio. Alphabets. First S, then T. Is it correct or not? Varun. RST. So Sharpe ratio, RP minus RF divided by sigma P, total risk. First we learned the total risk, right? And next what? Systematic risk. So Treynor's ratio is equal to RP minus RF divided by beta P. Clear? Done. So 26th you need not refer. So that is a simple question only. Next, 27th. 27th you have to refer. 27th you have to refer this question. 27th. Suppose that economy is growing rapidly. Suppose that economy is growing rapidly like India, and you are managing a global equity fund. So far, you have invested only in developed country stocks only. So far, you have invested only in developed country stock. Now you have decided to add stocks of economy A to your portfolio. The table shows the expected rates of a return, standard deviation, and correlation coefficient. All estimates are for aggregate stock market of a developed countries and stock market of economy A. Developed country stock of economy A. Expected rate of a return 10 and 15, risk 1630, correlation coefficient 0.3. Assuming the risk-free rate of interest to 3%, you are required to determine what percentage of your portfolio should you allocate to the stock of economy A if you want to increase the expected rate of a return on your portfolio by 0.5%. What will be the standard deviation of your portfolio assuming that stock of economy A are included in the portfolio as calculated above? Also show how well the fund will be compensated for the risk undertaken due to the inclusion of a stock of economy A in the portfolio. So this is a simple question, but when you see the words like developed country stock of economy A, okay, you feel like this is a new concept. Okay, so simple question. So till now you have invested only in what? Developed country stock. What is the expected return of a developed country? 10%. And the stock of economy A, 15%. What is the expected return of stock of economy A? 15. Economy A is developing. Economy A is developing. Risk 16 and what? 30. Standard deviation is given. Standard deviation of developed country is 16. Standard deviation of economy A 30. Correlation coefficient 0.3. Correlation coefficient 0.3. Assuming the risk-free interest rate to be 3%, you are required to determine. So what they are asking you to determine, first you have to understand the question. What percentage of your portfolio should you allocate to the stock of economy A if you want to increase the expected rate of a return on your portfolio by 0.5%? If you want to increase your return by 0.5%, what is your return as of now? 10%, because so far you have invested only in developed country stock. If you want to increase your return by 0.5, that means 10.5. What percentage you should allocate to the stock of a economy A? So I don't know. So that's why let us assume the proportion of stock of economy A is equal to P. What is your target portfolio return? 10.5. Then the proportion of stock of developed country is equal to 1 minus P. So 1 minus P into 10 plus P into 15 is equal to what? 10.5. So P 10%, 1 minus P 90%. So what is this P? Proportion of stock of economy A. Nothing but 10% of the portfolio should be allocated to the stock of economy A. Clear? First part. Second part. What will be the standard deviation of your portfolio? What will be the standard deviation of your portfolio? Assuming that stock of economy A are included in the portfolio as calculated above. As calculated above means what? 10%. So for suppose you included stock of economy A. So then what is the risk of a portfolio? Correlation coefficient is also given. What is the correlation coefficient? 0.3. Weights 0.9, 0.1. Developed country 0.9, developing country 0.1. Standard deviation of both the securities are given. Instead of giving X, Y, they have given what? Developed country and stock of economy A. So we have to apply the formula. Sigma P is equal to square root of Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy sigma x sigma y sigma x5. So what is the answer? 15.565. And most importantly, here the point to be referred is third part. Third part. Why third part? Because the reason is, so nowhere they have mentioned you to find out the Sharpe ratio. But the question is, show how well the fund will be compensated for the risk undertaken due to the inclusion of stock of economy A in the portfolio. You are adding the stock of economy A, and economy A standard deviation is 15. Show how well the fund will be compensated. Show how well the fund will be compensated. So here you should find out what Sharpe ratio. Sharpe ratio is equal to RP minus RF divided by sigma P. So before adding the stock of economy A, our return is 10, risk-free rate 3, RP minus RF divided by sigma P. What is the standard deviation of portfolio? Developed country 16. So 10 minus 3 divided by 16. So the answer is 0.4375. This is before adding the stock of economy A. But after adding the stock of economy A, the return is 10.5. Risk is 3. Sorry, risk-free rate is 3. So 10.5 minus 3 divided by risk is equal to 15.565. So Sharpe ratio is 0.482. What is the 0.482? Excess return for every 1% of a risk, total risk. So here the Sharpe ratio has got improved or not? As the Sharpe ratio has got improved by 0.045. Show how well the fund will be compensated. Show how well the fund will be compensated. As the fund is getting compensated, the Sharpe ratio is getting improved by 0.045. Higher the Sharpe ratio, better it is. Higher the Sharpe ratio, higher the Treynor's ratio, higher the Jenson's alpha, better it is. So we need excess return for every 1% of total risk. We need excess higher. Okay, so rank 1 goes to the security which is having a higher Sharpe ratio or a higher Treynor's ratio. Jenson's alpha means what? Actual return minus CAPM. CAPM is required return. So everybody wants what? Higher Jenson's alpha, higher Treynor's ratio, higher Sharpe ratio. Clear? Done. So this is what? Question number 27. So 27 is for what? Refer. 27 you have to refer. 28. So you need not refer 28. Characteristic line concept 28. 29 you have to refer. Let us see the 29. 29 you have to refer. 29. Assuming that shares of ABC Limited and XYZ Limited are correctly priced according to capital asset pricing model, the expected return from and beta of these shares are as follows. Shares XYZ ABC, beta 1.2, 0.9, expected return 9.8, 17.1. You are required to derive security market line. 29th question you have to refer. Security market line means it is not a new concept. Security market line is nothing but graphical representation of a CAPM return. Graphical representation of a CAPM return. CAPM return is equal to RF plus RM minus RF into beta. So in this question, first you should know. Okay, you should get an idea to form an equation. You should get an idea to form an equation. Expected return is given. What is expected return? 19.8, 17.1. So 19.8 is equal to, RF is not given in the question. RM minus RF is also not given in the question. So 19.8 is equal to RF plus RM minus RF into 1.2. Equation number 1. So this is similar to what the question number 14. Question number 14, third part. But why I am asking you to refer this question number 29? Because they have not mentioned you to find out RF or RM. They have asked you to derive security market line. Okay, the language is different, so that's why you have to refer. Equation 2, 17.1 is equal to RF plus RM minus RF into 0.9. Clear? Equation 1 minus 2, RF and RF will get cancelled. You can find out RM minus RF and then what? RF. Okay, and SML return is equal to, in security market line, RF is constant, RM minus RF is also constant. Only beta is variable. Security return and beta are variable. Security return and beta are variable. Yes or no? So SML return is equal to 9 plus 9 into beta. 9 plus 9 into beta, or else 18 minus 9 into beta. Clear? So what is this question? This is SML, security market line. So 30 is also what? Referral question. Question number 30. Question number 30 is referral question. Expected return on two stocks for particular market returns are given in the following table. Market return 725, aggressive stock 440, defensive 9 and 18. You are required to calculate the beta of two stocks. Only two periods are given. Change in security return divided by change in market return. Aggressive stock, what is the change in security return? 40 minus 4, 36 divided by 18. 25 minus 7. 36 divided by 18. 2. Clear? What about second? 18 minus 9 divided by 18. 0.5. So beta of the two stocks. So beta of aggressive is 2. Beta of a defensive is 0.5. You know the meaning of 2, right? For every 1% change in market, aggressive stock changes by 2. Defensive, for every 1% change in market, defensive changes by 0.5. Next, expected return on each stock. Expected return on each stock. So weighted average. How do we expected return on each stock? Expected return on each stock means simple average, not weighted average. 4 plus 40 divided by 2. 9 plus 18 divided by 2. Simple. Next, security market line. Security market line means what? Nothing but CAPM return. Calculate CAPM return. If the risk-free rate is 7.5, market return is equally likely to be 7 or 25. Market return is equally likely to be 7 or 25 means what? Simple average. 7 plus 25 divided by 2. 7 plus 25 divided by 2. 16, huh? 16. So aggressive stock CAPM return is equal to, what is the CAPM return aggressive stock? 7.5 plus 16 minus 7.5 into 2. 24.5. Defensive 7.5 plus 16 minus 7.5 into 0.5. 11.75. Next, D part. So D part, after dinner I will explain the concept of a characteristic line, but now I will explain the D part also. Alpha of the two stocks. Alpha means here not the Jenson's alpha. Characteristic line alpha. Characteristic line is equal to alpha plus beta into RM. Alpha plus beta into RM. For aggressive stock, characteristic line is nothing but what? Security return. Return of a security is equal to alpha plus beta into RM. For aggressive stock, what is the return? 22. For aggressive stock, what is the return? 22. 22 is equal to alpha plus 2 into, okay, beta into RM. RM 16. So alpha is equal to minus 10. And defensive 13.5 is equal to alpha plus beta 0.5 into RM 16. Alpha is equal to 5.5. So this characteristic line concept I have to explain. So okay, after dinner, so let us recall what security market line, capital market line, characteristic line, and Sharpe index model. So we have questions to be practiced: 31, 32, 33, 34 refer. So another 3 questions are practice, and in addition we have another question. So total 4 practice questions are remaining. CA final November 23 question is remaining. That question you have to practice. I mean, after dinner we have to practice, and later on what MCQs. MCQs will not take much time. Okay, clear? Everybody. So 8:30 again our session will start at 8:30. Our session again starts at 8:30, half an hour break, and everybody please in half an hour also while having dinner please recall the concepts, okay? Especially what practice questions. Clear? Online students please. So see the next concept: security market line, capital market line, characteristic line. So straight line equation y is equal to a plus bx. In straight line equation y equal to a plus bx, a and b are constants, x and y are variables. If you see the CAPM return, so company to company beta changes, right? But RF and RM minus RF are constant. So security market line is a graphical representation of CAPM return. It denotes the relationship between security return and beta. Security return and beta. Nothing but whenever the beta changes, security return is also going to change. And beta denotes responsiveness of security return with respect to change in market return. So SML return is equal to RF plus RM minus RF into beta. Or else you can write beta divided by beta M. Beta of a market is always equal to what? 1. Beta of a market is always equal to what? 1. Clear? Capital market line. Capital market line is similar to security market line. It denotes the relationship between security return and total risk. Security return and total risk. So that's why CML return is equal to RF plus RM minus RF into sigma S divided by sigma M. Instead of taking beta, we should take sigma S. Sigma S divided by sigma M. So this CML return again we are going to recall in mutual funds concept. Pharma selectivity. Pharma selectivity. Okay. And next characteristic line. Characteristic line denotes the relationship between security return and market return. In SML, beta is the variable. In CML, total risk is the variable. But in characteristic line, RM is the variable. RM is variable. Okay. So in all the 3 lines, security return is the variable. Left hand side security return. Security return is equal to RF plus RM minus RF into beta. Okay. Security return is equal to RF plus RM minus RF into sigma S divided by sigma M. And security return is equal to alpha plus beta into RM. Alpha plus what? Beta into RM. So alpha is equal to, return of security is equal to alpha plus what? Beta into RM. Nothing but in one question we have calculated expected return. Do you remember? Beta into RM. In one question we calculated what? Beta into RM. You should know the difference between the characteristic line alpha and Jenson's alpha. Jenson's alpha is equal to actual return minus CAPM return. But characteristic line alpha is equal to actual return minus B into RM. So beta into RM. In one question we have calculated what? Expected return by multiplying beta with what? RM. So alpha is equal to what? Return of a security minus beta into RM. Nothing but return of a security is equal to alpha plus beta into RM. In characteristic line, alpha and beta are constant. Alpha and beta are constants. Clear? The next concept, systematic risk, unsystematic risk. You know the Markovich formula. Markovich formula, total risk sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. Or else, instead of sigma x, sigma y and sigma xy, we can use covariance of a x comma y. Covariance of a x comma y. Okay, but Sharpe index model. Sharpe index model. Total risk is equal to systematic risk plus unsystematic risk. Under Sharpe index model, we follow the variance approach. Total risk is equal to variance. Total risk is equal to variance. Sigma s square. How do we get systematic risk? So generally, till now we have told that beta denotes the systematic risk, but beta is a ratio. Beta is a ratio. Standard deviation is a percentage, variance is also a percentage, but beta is a ratio. So systematic risk, I cannot take beta because beta is a ratio. And how do I get unsystematic risk? Unsystematic risk is equal to total risk minus systematic risk. So there is no difference between unsystematic risk and residual variance. Residual means left out. Residual means what? Left out. Residual variance is nothing but what? Unsystematic variance, unsystematic risk. How do we get unsystematic risk? Total risk minus systematic risk. So systematic risk is equal to beta square because we are following the variance approach. So that's why beta square into sigma m square. We should convert the ratio into percentage. So to convert the ratio into percentage, we are multiplying beta with what? Sigma m square. So beta s square sigma m square. Unsystematic risk, sigma s square minus beta s square into sigma m square. This concept was tested in June 2025. June 2025. Sigma s square minus beta s square into sigma m square. Risk of a portfolio. Risk of a portfolio. Risk of a portfolio, sigma p square. Systematic risk is equal to beta p square into sigma m square. Instead of beta of a security, we take beta of a portfolio. Beta p square into sigma m square. So what about the unsystematic risk? Sigma p square minus beta p square into sigma m square, or high chances of forgetting the second formula. WA square unsystematic risk of A plus WB square unsystematic risk of B, and so on. So unsystematic risk of a portfolio, another formula, WA square unsystematic risk of A plus WB square unsystematic risk of B, and so on. Clear? Done? Okay, so value of a levered firm is equal to value of unlevered plus debt into tax rate. This is approach. This formula it will be useful in business valuation. But there is another formula, so which is right now important. So that is beta of levered firm is equal to beta of a levered firm is equal to, in June 2025 they have tested this concept. Beta of a levered is equal to beta of unlevered plus beta of unlevered into debt divided by equity. Debt divided by debt plus equity. Debt divided by debt plus equity. In June 2025, this concept was tested. Okay. So beta of a levered, so debt divided by equity, debt divided by equity. So levered beta is equal to unlevered beta plus unlevered beta. Levered beta is equal to unlevered beta plus beta of a unlevered firm into debt divided by equity into 1 minus tax rate. Into 1 minus a tax rate. Levered beta is equal to unlevered beta plus. So generally beta of a levered firm will be greater than the unlevered firm beta, because levered firm is facing a risk. Okay, so beta of levered firm is facing risk. So that's why beta of a levered is equal to beta of a levered BL is equal to BU plus BU into D by E into 1 minus tax rate. Okay, So question was simple 5A, but the concept is here they have asked the levered beta and next what? Unlevered beta. So next and all simple. CAPM written RF plus RM minus RF into beta. CAPM written and next what? Jenson's alpha. Simple question. But the new point is what? Levered beta. So levered beta is equal to unlevered beta plus unlevered beta into debt divided by equity. Am I clear? Done. Okay. So this question. And next, let us go through the questions. So this question number 31 asked in June 2025. Now this question you need not practice because this question was asked in June 2025. But I'll explain the concept. Following are the details of portfolio consisting of 3 shares. ABC, portfolio weight, beta, expected return in percentage, total variance. Total variance. Standard deviation of a market portfolio is equal to 10%. You are given the following additional data. Covariance A comma B, covariance A comma C, covariance B comma C. Calculate the following. After completion of these questions, so I'm going to mention, special points. Okay, left out. Risk penalty, risk utility. So those concepts which are useful for bullet MCQs. Okay. Calculate the following. Portfolio beta. Simple portfolio beta. By doing weighted average, we can find out what portfolio beta. Second, residual variance. Residual variance is nothing but what? Unsystematic risk. Residual variance of each of the 3 shares. How do we get residual variance? Total risk minus systematic risk. Total risk means total variance. So here, high chances of doing a clerical mistake because the reason is, so do not try this, try to convert this number 0.015 into a percentage. So to convert this 0.015 into a percentage, you should multiply with 10,000 because this is variance, not a standard deviation. Once again, I'm repeating 0.015. Generally, you will be multiplying with what? 100. No, we should multiply with what? 100 square because it is variance. So 10,000. So, but my recommendation for this question is you should not convert these numbers into a percentage. Take the number as it is. Write the answer as it is. Do not try to convert the numbers into a percentage. So total variance minus systematic risk. How do we get systematic risk? Systematic risk is equal to beta square sigma m square. Beta 0.4 square into sigma m 0.1 square. Okay, clear? Okay. Next, portfolio variance using Sharpe index model. Portfolio variance using Sharpe index model. Portfolio variance using Sharpe index model. How do we get portfolio variance using Sharpe index model? Simple. How do we get systematic risk of a portfolio? How do we get systematic risk of portfolio? Beta p square into sigma m square plus unsystematic risk of portfolio. How do we get unsystematic risk of portfolio? High chances of forgetting the formula. WA square unsystematic risk of A plus WB square unsystematic risk of B plus WC square unsystematic risk of a C. Clear? Next, portfolio variance on the basis of market. Modern portfolio theory. Modern portfolio theory, simple. Square root of WX square sigma x square plus WY square sigma y square plus WZ square sigma z square plus 2 WX 2 WY covariance of x comma y 2 WX WZ covariance of x comma z plus 2 WY WZ covariance of y comma z. So the formula will be similar to what? A plus B plus C whole square. Clear? So maximum they will be giving 3 securities. 3 securities. Modern portfolio theory is nothing but the formula which we have learned in the beginning. Okay? Clear? Question number 31. Is it clear? Fine. So this question is not for practice now, but for December 25, because so this was tested in June 2025. Question number 32. Question number 32, you have to practice. Question number 32. The return on stock A and market portfolio for a period of 6 years are as follows. Year 1 to 6, return on A, return on a market portfolio. You are required to determine characteristic line of a stock A, the systematic risk and unsystematic risk of a stock A. So this question you have to practice. So what is a systematic risk and unsystematic risk and characteristic line? Characteristic line is equal to alpha plus beta into RM. Okay, so to determine the characteristic line, we should find out what? We should find out, okay, beta. How can we find out beta? Covariance of S comma M divided by sigma M square. For covariance of S comma M, obviously you will be finding out what S bar and also what M bar. S bar is return of a security, M bar is RM. So RS, RM and beta. By substituting RS, RM and beta, we can find out what? Alpha. So that's how we can complete what? Characteristic line. So you know the columns for covariance of S comma M. Sigma M square columns, you know the columns of sigma M square. Okay. Next, but here you should see the second part also. What is the second part? The systematic and unsystematic risk of stock A. Systematic risk and unsystematic risk. How do we get systematic risk? Beta S square into sigma M square. Anyway, we are going to find out sigma M square for beta. Beta also we are finding out for the first part. Fine. What about unsystematic risk of security? How do we get unsystematic risk of security? Total variance of security minus systematic risk. So total variance means sigma S square. We need sigma S square also. So that means in this concept, in this question, first part, we should find out sigma S square. Second, sigma M square. And then what? Covariance of a S comma M. Sigma S square columns. Here S, S bar, S minus S bar, S minus S bar square. Sigma M square columns. Here M, M bar, M minus M bar, M minus M bar square. Next, covariance of S comma M. Here S minus S bar, M minus M bar, S minus S bar into M minus M bar. Simple. Okay. So 32nd question, you refer, you practice afterwards. Okay. What is the time? 8:50. You can practice now. 10 minutes. Solve it within 10 minutes. Within 10 minutes, solve this question. Next SFM grant test, I will ask you simple questions from portfolio management, 2 simple questions, descriptive, but you will not be able to answer. Let's see. You need concepts. Open branch in Warangal. Varsha, branch in Jammu Kashmir. You are asking to open branch in Jammu Kashmir, right? Neeraj, your senior asking you to open branch in Warangal. You are from Warangal, right? NTPC. Sure, Neeraj. हो गया क्या सबका? Next question number 33. So this question is also for practice and chances that you may get this question for December 25. Question number 33. 33. A study by mutual fund has revealed the following data in respect of 3 securities. Security A, B and C. A, B, C. Standard deviation and correlation with index. Correlation with index means sigma AM, sigma BM, sigma CM is given. The standard deviation of market portfolio is observed to be 15%. What is the sensitivity of returns of each stock with respect to the market? What is the sensitivity of returns of each stock with respect to the market? What is the sensitivity? Sensitivity means what? Sensitivity of a return of each stock with respect to market means nothing but beta. They're asking you to find out beta. How can we find out beta? Correlation with index is given. Sigma SM into sigma S divided by sigma M. Sigma SM clear? Sigma SM into sigma S divided by sigma M. Clear? Beta calculation. Next what? Covariance. So this is the special point. The covariance of. What are the covariances among various stocks? So tell me the formula for covariance. Covariance is equal to. So we use summation sigma dx into dy. Deviation of x into deviation of y divided by n. So that formula we cannot apply here. Summation sigma p probability into dx into dy. That formula we cannot apply. There is another formula sigma x sigma y sigma xy. Sigma x is given in the question, sigma y is given in the question, sigma xy is not given. That is sigma AB. Correlation between the stocks is not given. Correlation of stock with market is given, but correlation between the stocks is not given. So that's why we cannot apply sigma x, sigma A, sigma B, sigma AB. So high chances of forgetting one formula. I told you. What is that formula? Beta A, beta B, sigma m square. Beta A, beta B, sigma m square. Okay, so you have to apply that formula. Beta A, beta B, sigma m square. So covariance matrix. Covariance of A with A is nothing but variance. Covariance of A with A is nothing but variance. A minus A bar into A minus A bar. It is nothing but what? Variance. Next. So they have asked you to find out the risk of a portfolio using consisting of all the three stocks equally. So risk of a portfolio, nothing but what? Market. So Markovitch modern portfolio theory, square root of wx square sigma x square, wa square sigma a square plus wb square sigma b square plus wc square sigma c square plus 2wa wb covariance of a comma b plus 2wa wc covariance of a comma c plus 2wb wc covariance of a b comma c. By substituting you will get the answer. Next what? Beta of a portfolio. Investment is made equally. We do a simple average. Last one. They have asked you to find out what? Total systematic risk and unsystematic risk. How do we get systematic risk of a portfolio? Beta p square into sigma m square. Beta p calculated in fourth part into sigma m square. Beta p square into sigma m square. And next what? Unsystematic risk. How do we get unsystematic risk? Total risk. Total variance is already calculated in third part. Total variance minus systematic risk. Unsystematic risk. Clear? So 10 minutes time, practice this question. Solve this question. 10 to 12 minutes time. Solve this question. Solve this question. Mahima Singh, your phone internet data has gone. Okay. Question number 34. Next question number 34. This question you have to refer. You have to refer this question. An investor is proposing to invest 10,000 in two portfolios A and B in the ratio of 3:2. The portfolios have three securities each with the following weights. Weight of X, Y, Z. Portfolio A, B. Portfolio A, and B. You are required to calculate the weight of each stock. You are required to calculate the weight of each stock. Calculate the amount allocated to Y and Z if half of the funds are allocated to security X. In CA final, it was asked for 8 marks. For us, they may ask it for 7 marks. Calculate the weight of each stock. Simple question. So there are 3 securities and 2 portfolios. Portfolio A is containing XYZ. B is also containing XYZ. But the proportions are different. 0.3, 0.25, 0.45, 0.2, 0.45 and 0.35. Clear? So calculate the weight of each stock. How do we get weight of each stock? Simple. 10,000 rupees is the investment. It is invested in A and B in the ratio of 3:2. 6,000 and 4,000. 6,000 and 4,000. Clear? So this 6,000 rupees in portfolio A invested in the ratio of 0.3, 0.25, 0.45. So 1,800, 1,500, 2,700. 2,700. Clear? Next what? Portfolio B. 4,000 rupees invested in the ratio of 0.2, 0.45, 0.35. 800, 1,800, 1,400. Overall, 2,600 rupees. 2,600 rupees invested in X. 3,300 in Y. 4,100 in Z. So what is the proportion? 0.26, 0.26, 0.33, 0.41. 0.41. Clear? So this is the first part. Weight of each stock. Second part. Amount allocated to security X is half of the amount. Amount allocated to security X. What is the amount? 5,000. Out of 10,000, half allocated to security X. That means 5,000. What is the balance amount? 5,000. So this balance amount will be allocated to Y and Z in the ratio of 0.33 is to 0.41. Existing ratio. Why the existing proportion? Because they might be following these proportions. They might be following these proportions because that might be what? Minimum risk portfolio. Minimum risk portfolio proportions, minimum risk proportions. So that's fine. So 5,000 into 0.33 divided by 0.74, 2230. 5,000 divided by 0.74 into 0.41, 2770. Clear? Clear? Am I clear? Now one question. So this question you are not going to solve this. Additional question number 5. I will give you 15 minutes time. At least you start. Without seeing the answer, if you can, at least start the question. Then you will get 2 apples. Question number 5. Do not see the answer. Question number 5. You know the concept already. They are asking you to. Jenson's alpha is given. Treynor's ratio is given. Actual return is given. Risk premium is given. Risk premium. That risk premium means what? RM minus RF. You can assume this 4% as RM minus RF, or else you can assume this 4% as RM minus RF into beta. Anything. 2 alternative answers are given in CA final. Suggested answer. And this is not the CA final question. First it was asked in CA final, and then in next attempt it was asked in CMA final. Okay. So May 2023 CA final question. Beta, risk-free rate, security, market line. Try this question. Pause the video. Try this question. You will not get an idea how to start also. If you can complete, okay, fine. So this is the CA final past question. So let me explain the solution. Let me explain the solution. First, Jenson's alpha is given. For smart, Jenson's alpha is given. Yes or no? Treynor's ratio is given. Actual return is given. Risk premium is also given. RM minus RF 4%. If you have a confusion, then you can assume this 4% as what? RM minus RF into beta. Because they have mentioned risk premium. Risk premium means can be market risk premium or security risk premium. Security risk premium. Market risk premium means RM minus RF. Security risk premium means RM minus RF into beta. Anything you can assume. So Jenson's alpha 1.1. Actual return is also given 8.5. So Jenson's alpha is equal to what? Actual return minus CAPM return. So I can find out what? CAPM return. So CAPM return is equal to what? Actual return minus Jenson's alpha. So what is the CAPM return? 7.4. Clear? So 7.4 CAPM return is equal to, what is the formula for CAPM return? RF plus RM minus RF into beta. So 0.074 is equal to 0.04 beta, because we know the RM minus RF. What is RM minus RF? 0.04. So 0.04 beta plus RF. So this is equation number 1. Equation number 1. Clear? Now Treynor's ratio. What is the Treynor's ratio formula? RP minus RF divided by beta P. Treynor's ratio is given in the question. 0.0714 is equal to RP. RP means actual return. Security. Very good, Amaran. Actual return of security. 0.085 minus RF divided by beta. Again 0.085 is equal to 0.0714 beta plus RF. This is equation number 2. So if you do equation 1 minus 2 or 2 minus 1, RF will get cancelled and you can find out what? Beta. So beta is equal to 0.35. RF is equal to 0.06. And they have asked you to determine the security market line. Security market line is equal to RF 0.06 plus RM minus RF 0.04 into beta. This is for smart. Likewise, we should find out for what? Growth. Growth RF will be same. RM will also be same. Only beta is going to change. Clear? Tarun Jain, do we need to refer CA material? You need not refer CA material. I refer CA material. I will work for you, okay? You just refer my material, okay? Thank you. Clear? So with this we have completed what? Descriptive questions. Now comes the session. What is the session? MCQs. Let us enjoy. Session. MCQs, multiple choice questions. From this portfolio management, 5 MCQs in June 25. 5. I will show you now. The portfolio distribution of security, and so for MCQs, no extra knowledge is required. Even extra means what? Hardly we learn 2 or 3 extra points. That's it. First, we should know the descriptive concepts like Treynor's ratio, Sharpe ratio. You need that knowledge. So, portfolio distribution, security N is given below. The risk of a return of the security will be the risk of a return. Risk of a return of the security means nothing but they are asking you to find out the risk. Probability is given, return is given. How do we find out the risk? Simple. X, P into X, X minus X bar, P into X minus X bar whole square. So sigma X is equal to what? 8%. Simple. Clear? Next. Second question, December 17th, past question. These are all past MCQs. For a portfolio management, for a portfolio containing 3 securities A, B and C, correlation coefficient sigma AB is equal to plus 0.4, sigma AC 0.75, sigma BC minus 0.4. Standard deviation sigma A is equal to 9, sigma B is equal to 11, sigma C is equal to 6, weight of A 0.2, weight of B 0.5, weight of C is equal to 0.3. Covariance of a security A and B. Unnecessary information is given to deviate, okay, U. Unnecessary information. Covariance of a security A and B. Simple. Covariance of security A and B is equal to sigma A, sigma B. Sigma A is given, right? Sigma A, sigma B into what? Sigma AB. 9 into 11 into 0.4. Answer 39.6. The following statement is true if R denotes the correlation coefficient. B, if R is equal to -1 implies full diversification of securities in the portfolio. Obviously, if a correlation coefficient is -1, risk can be fully diversified. Risk can be reduced to 0. Next, fourth one. Mrs. P is planning to construct a minimum risk portfolio. Planning to construct a minimum risk portfolio by investing in the shares of N and S Limited. N and S Limited. Okay, so many students without learning the concept, they are expecting MCQs in last minute. This is not law to by heart the answers. So this is SFM. You should know the concept. Otherwise, you will not be able to solve. Okay. So he is planning to construct a minimum risk portfolio by investing in the shares of N Limited and S Limited. The risk associated with the return of N and S are 23, 25. Standard deviation are given. If the covariance between the return of the shares of both the securities is 0, what is the covariance? 0. Then the proportion of funds to be invested in the shares of N Limited is. Okay. So here covariance is equal to 0. Covariance 0 means sigma AB will also be 0. So minimum risk portfolio. To construct minimum risk portfolio, weight of X is equal to sigma y square minus covariance of X comma Y divided by sigma X square plus sigma Y square minus 2 covariance of X comma Y. Simple. Fifth, an investor has limited funds to invest. The following information of 4 securities is given. Limited funds. Security A, B, C, D. Standard deviation is given. Average return is given. The best security to invest if he wants more safety in relation to return. He wants more safety means what? Less risk. 4 securities are there. We find out what? Coefficient of a variation. How do we get coefficient of variation? Standard deviation divided by average return. Standard deviation divided by average return. Low coefficient of variation indicates low risk. It is not a percentage. We should not multiply with 100. So which security is having a lower coefficient of variance? 64. Okay. So security C is having a lower coefficient of a variance. Next, you are given the following information. Required return on risk-free security 7. Required return on market 12, beta 1.7, CAPM. CAPM is equal to RF plus RM minus RF into beta. Simple. Next, project X is to be financed by 40% debt with a 0 beta, 60% equity with 1.3 beta. If the risk-free rate is 13%, market portfolio is 12%, return from the project will be. Simple. First we should find out what asset beta. How do we get asset beta? Weighted average. 60% equity. Equity beta is equal to 1.3. 60% into 1.3. 0.78. CAPM is equal to RF plus RF 13 plus RM 22 minus 13 into beta 0.78. So the answer is 20.02. Eighth question is also same. Eighth question is also same as it is. So that's why I'm not explaining it. Okay. Next, ninth question. An investor invested 40% of her money in stock A, 60% in B. Stock A has a beta of 1.2, B has a beta of 1.6. Risk-free rate is given. Market return is given. So CAPM. First we should find out weighted beta. Weighted beta 40% into 1.2 plus 60% into 1.6, 1.44. And next what? RF plus RM minus RF into beta. Okay. So these MCQs are not simply bit. Okay. I have worked for 1 week. Study material MCQs plus past MCQs, and next what? Eliminating all the repetitive MCQs, and I have arranged all the MCQs in ascending order. Easy to hard. Okay. So these MCQs are very important. If you have time, then we can go through what other MCQs as well. But these MCQs are very important. Z Limited shares are traded in stock exchange. The standard deviation of Z shares and market are 6% and 4% respectively. If the correlation coefficient for the shares in the stock market is 0.8, what will be the beta coefficient of the company's shares based on the CAPM? What is given? Sigma S is given, sigma M is given, correlation coefficient is given. They are asking beta, simple. Sigma SM into sigma S divided by sigma M. So the answer is 1.2. Next, 11th question. If the covariance between the return on a portfolio BC and return on the market index is 25, the variance of returns on the market index is 20. What will be the systematic risk of a BC under variance approach? They are asking what? Systematic risk under variance approach. Systematic risk under variance approach is equal to beta S square into sigma M square. First we should find out beta. How can we find out beta? Okay, covariance between portfolio and market 25. Variance of market 20. We can find out beta. Beta is equal to 1.25. Systematic risk is equal to beta S square. That means 1.25 square into 0.22 square. That's about 20 square. 1.25 square into what? Sorry, 20. 1.25 square into 20, not 20 square. So answer is 31.25. Clear? A firm has an asset beta is equal to 1.3, equity beta 1.5. Then which of the following is true? Asset beta 1.3, equity beta 1.5. Asset beta is not equal to equity beta means what? The firm might be what? Levered firm. Levered firm means the firm which is using debt. Levered firm, and debt beta is lower than asset beta. Obviously, if we do the weighted average of debt beta and equity beta, then you will get asset beta. Asset beta lies between what? Debt beta and equity beta. Clear? An investor owns a stock portfolio equally invested in risk-free asset and two stocks. If one of the stock has a beta of 0.75, if one of the stock has a beta of 0.75, investor invested equally in risk-free asset and two stocks. One stock is having beta 0.75. Portfolio is as risky as the market. This is a special point. Portfolio is as risky as the market means what? Portfolio beta is equal to 1. So special point. Portfolio is as risky as the market means what? Portfolio beta is equal to 1. So find out the beta of the other stock. Simple. How do I get portfolio beta? By doing a weighted average of security beta. Okay. So beta P is equal to beta A WA plus beta B WB plus beta RF into WRF. So beta of a risk-free security, you should know the concept. Beta of a risk-free security is equal to 0. So 1 is equal to 0.75 into 1 by 3 equally invested plus beta B into 1 by 3. So beta B is equal to what? 2.25. Is it clear, everybody, online students? The following is not a systematic risk. Business risk is not a systematic risk. That depends upon the nature of business. So, okay, company specific. So that's why what? Business risk is not a systematic risk. But interest risk, market risk, purchasing power risk, these are all systematic risk. 15th question. It was asked in June 25. Last MCQ. A portfolio holding 90% of its asset in CNX Nifty stock. 90% in CNS Nifty in proportion to their market capitalization and 10% in treasury bill. 10% invested in treasury bill, 90% invested in market is more sensitive to systematic risk because 90% is invested in market. Systematic risk denotes responsiveness of security return with respect to change in market. You invested 90% in market, so that's why what? You will have a systematic risk. Next, security A has a total risk of A. Security B has a total risk of B. A is greater than B. Security A has a total risk of A. Security B has a total risk of B. A is greater than B. The following is true. Okay. A is greater than B means nothing but what? Risk of A is greater than risk of a B. So A can have a lower systematic risk than B. Total risk of A is greater than B. That doesn't mean what? Systematic risk of A must also be greater than B. Here it is not must. If you see the first three sentences, if A has a high systematic risk, if A has a higher systematic risk, B will have a higher unsystematic risk. Will have means what? Mandatory. No. Okay, if A has a higher systematic risk, what? B can have a lower, okay, systematic risk. Are you getting my point? Second also, A has to have a higher systematic risk. A has to have a higher systematic risk. Again, this is also what? Compulsory sentence, mandatory. So that's why this is not correct. A has to have at least the same amount of systematic risk. That is also not correct. Why D is correct? It is not mandatory. A can have, not will have. A can have a lower systematic risk than B. So that's why the answer is what? D. Which of the following is true? Which of the following is true? Systematic risk is independent of the industry to which the security belongs. Next, 18th question. Expected return, standard deviation, beta are given. Variance of a return on the market index 225. Correlation coefficient between A and B 0.75. Systematic risk of a portfolio consisting of two securities in equal proportion. First we should find out beta of a portfolio. What is beta of portfolio? 0.9 plus 1.4 divided by 2 because equal weights. 0.9 plus 1.4 divided by 2. 1.15. So systematic risk is equal to beta p square 1.15 square into 225. Okay. Clear? Done? Next, SML shows the relationship between return on the stock. Here you have to be careful. 19th. Security market line shows the relationship between return on the stock and return and beta of the stock. Yes or no? SML denotes the relationship between return of the security and beta. Next, these are frequently asked. The intercept of the SML on the y-axis is RF, risk-free rate. Intercept. What is this intercept? Okay, x-axis, y-axis. Here beta. Here the return of security. If beta is equal to 0, still we get what? RF. If a beta increases, what happens? Return of security increases. Return of security is equal to RF plus RM minus RF into beta. So RF is an intercept. RF is an intercept. RF is what? Intercept. You should know the three lines: security market line, capital market line, and what? Characteristic line. In characteristic line, alpha is the intercept. RF plus RM minus RF into beta. Alpha plus beta into RM. So alpha is what? Intercept in characteristic line. In security market line, RF is the intercept. What about RM minus RF? RM minus RF is a slope. RM minus RF is what? Slope. Okay. So the slope of a security market line denotes risk premium required. Slope denotes what? Risk premium required. RM minus RF into beta or RM minus RF. Okay. Next. While plotting a graph with risk on x-axis, beta on x-axis, And expected return on y-axis, expected return of security on y-axis. A line drawn with coordinates 0 RF and beta RM is called security market line. Security market line. Because risk on x-axis, expected return on y-axis. For all the three lines, expected return will be on y-axis. Expected return will be on y-axis. Clear? Beta will be on what? X-axis. Beta will be on what? X-axis. For capital market line also, total risk will be on what? X-axis. But that is what? Sigma S divided by sigma M. Sigma S divided by what? Sigma M. Sir, here for capital market line also, risk will be on x-axis. Then why the answer cannot be capital market line? Because they have clearly mentioned coordinates. What are the coordinates? 0 RF and next what? Beta RM. So obviously the answer will be what? Security market line. For characteristic line, RS will be on y-axis. I mean expected return will be on y-axis. Market return will be on x-axis. Market return will be on x-axis. Clear? Which is x-axis? So this is x-axis. Next what is this one is y-axis. Clear? Which of the following statements are true? For a characteristic line, y-axis represents return of the particular security. S. For all the lines, y-axis represents what? Return of a particular security, and x-axis represents return for the market index. Clear? The slope of SML is the beta for the particular security. No. Slope of SML is what? Risk premium. So the answer is only one above. The following is not a feature of a capital market line. Diversification can minimize the individual portfolio risk. Is not a feature of capital market line. Next, 25th. A certain mutual fund has a return of 17. Standard deviation 3.5. Sharpe ratio is 4. Sharpe ratio 4. Risk-free rate is. You know the Sharpe ratio formula. RP minus RF divided by sigma. Here Sharpe ratio is given 4. Sigma is given 3.5. And what? RP is given. What is RP? 17. We should find out RF. RF is equal to 4 into 3.5 minus 70. Minus a plus? 17 minus 4 into 3.5. 3%. Clear? So this is the June 25 question. June 25. December 24 and also what? June 25. A portfolio manager realized an average annual return 15%. So okay, this is not a June 25 question. This is December 24. Simple return 15, beta 1.2 given for deviating you. Standard deviation 25%. The average annual return on market index 11. Unnecessary information. Standard deviation of market 20. Unnecessary. Risk-free rate 4. Relevant information. Sharpe ratio. RP minus RF. RP 15 minus RF 4 divided by standard deviation 25. So the answer is 0.44. So this is the June 25 MCQ. Sharpe ratio 0.56. Treynor's ratio 9.8 respectively. Correlation coefficient between return of the fund and market. Nothing but sigma SM. Sigma SM 0.7. What is the standard deviation of the market index? They are asking you to find out sigma M. Sigma M. So this is okay, tricky MCQ. Tricky MCQ asked in June 2025. Okay. So last time also I have explained this MCQ. You know the Sharpe ratio formula. What is the Sharpe ratio formula? RP minus RF divided by sigma P. Okay. Treynor's ratio formula. RP minus RF divided by beta P. Okay. So you know the formula. Sharpe ratio and what? Treynor's ratio. Treynor's ratio. Clear? So, for suppose Treynor's ratio into what? Sharpe ratio is equal to what? Sharpe ratio. So, if Treynor's ratio is equal to Rp minus Rf divided by beta. So, Rp minus Rf can be written as what? Rp minus Rf is equal to Treynor's ratio into beta. Can we write like this or not? Rp minus Rf is equal to Treynor's ratio into beta. Yes or no? So Sharpe ratio is equal to, instead of Rp minus Rf, I can write Treynor's ratio into beta divided by what? Sigma S. Okay. So Treynor's ratio into beta formula, I can use the third formula. What is the third formula? Beta formula. Sigma Sm into sigma S divided by sigma M divided by what? Sigma S. Sigma S. Clear? Then what happens? Sigma S will get cancelled. Sigma S will get cancelled, and I will be left with what? Treynor's ratio into sigma Sm divided by sigma M. I know the Sharpe ratio. I know the Treynor's ratio. I know the sigma Sm. I have to find out what? Sigma M. Okay. So nothing but Treynor's ratio divided by Sharpe ratio into what? Treynor's ratio divided by Sharpe ratio into what? Sigma Sm. Clear? Are you able to understand the process? Once again, Treynor's ratio is equal to Rp minus Rf into beta. Last minute students might have heard about, they might have gone through this bullet MCQs video, but what? In examination, they may not, because the reason it is tricky. Treynor's ratio, Rp minus Rf divided by beta. That means Rp minus Rf is equal to Treynor's ratio into beta. Sharpe ratio is equal to Rp minus Rf divided by sigma P. So instead of Rp minus Rf, I can write Treynor's ratio into beta. So beta can be written as sigma Sm into sigma S divided by sigma M. Whole divided by what? Sigma S. Sigma S will get cancelled. So then Sharpe ratio is equal to Treynor's ratio into sigma Sm divided by sigma M. Sigma M is equal to what? 12.25. This MCQ also asked. 28th MCQ. Sharpe ratio, Treynor's ratio, 0.37, 4.16. Risk premium, 6%. Standard deviation, 11.8. Standard deviation of market, 9.56. The correlation coefficient between return of the fund and market. Correlation coefficient means they are asking you to find out sigma Sm. Sigma Sm. So all quality MCQs, I have picked all the quality MCQs only. Okay. I have eliminated all unnecessary MCQs. Simple Sharpe ratio formula. What is the Sharpe ratio formula? Rp minus Rf divided by sigma P. Sharpe ratio, we know the Sharpe ratio. We know the Sharpe ratio, yes or no? And we also know the standard deviation of the security, 11.8. We can find out what? Rp minus Rf. Substitute this Rp minus Rf in Treynor's ratio formula. We know the Treynor's ratio. So substitute Rp minus Rf and we can find out what? Beta. You know the beta formula. Sigma Sm into sigma S divided by sigma M. You know beta. Sigma S and sigma M. We can find out what? Sigma Sm. So this is also a past MCQ. Which of the following statement defines an efficient market? Efficient market hypothesis. This is also a frequently asked, frequently tested concept. Frequently tested concept. Information is efficient market hypothesis. We have three forms of a efficient market hypothesis. One is weak form of efficiency. Second, semi-strong. Third, strong form of efficiency. Okay. So here efficient market hypothesis means here we take an assumption markets are efficient. Markets are efficient. We cannot make abnormal profits. We cannot make abnormal profits. So we cannot make abnormal profits, and all available information is fully reflected in stock prices. Whatever the information available is fully reflected. It is impossible to consistently earn abnormal or excess return by using that information. So this is the efficient market hypothesis, frequently tested concept. So nothing but nobody can consistently make abnormal profits, because the reason is all available information is fully reflected in stock price, because markets are efficient. Investors are rational. Investors are rational. So securities are correctly priced. There is no under or overpricing, and we cannot make abnormal profit. Okay, you cannot beat the market through stock picking or a market timing. Clear? The only way to earn higher return is by taking higher risk. There are three forms of efficient market hypothesis. So remember this text. Weak form of efficiency means only the past information is reflected in the stock price. Past information. Historical information is reflected in the stock price. Historical information is reflected in the stock price. What is this information? Information means what? Example, company's quarterly financial results, book value per share, price earning ratio, earnings per share. So this is called as a fundamental analysis. Fundamental analysis. So reflects a past information. Weak form of efficiency. Weak form of efficiency means the past information is reflected in the stock price. That means stock price will be absorbing all the past information. This is weak form. Semi-strong means reflects publicly available information. Publicly available. Publicly available means past information plus present information. Current publicly available information is reflected in stock price. So this is called what? Semi-strong. Okay. If there is a weak form of efficiency, technical analysis will not work, but fundamental analysis may work. Fundamental analysis may help you, because the stock price is not taking into account the current information. Semi-strong means what? Neither technical nor fundamental analysis, which will not work. Technical analysis means what? Technical analysis assumption is history will repeat. The trend will repeat. History will repeat. History or a trend. Technical analysis means what? Simple. Whatever I'm doing now is technical analysis. I'm analyzing the past, and I'm assuming that what trend will, history will repeat. Okay. Strong form of efficiency means strong form of efficiency reflects public information plus insider information. Public plus what? Insider information. So if there is a strong form of efficiency, even an insider cannot make a profit. Even insider cannot earn abnormal return. Why insider cannot earn profit? Because already insider information is also reflected in what? Stock price. What is insider information? Insider information means what? For suppose if there is a merger, for suppose X company is getting merged with Y Limited. So that is insider information. CEO is going to change. Insider information. So obviously they will make an announcement, yes or no? But before making an announcement, insider, I mean the directors, okay, the top level management will be knowing that information, right? So with that information, what they can make a profits by selling the stock or buying the stock, yes or no? So insiders can earn a profit in semi-strong form of efficiency and in weak form of efficiency, but they cannot make profit when there is a strong form of efficiency, because strong form of efficiency means what? All informations, whether it is publicly available or privately available, all the information is reflected in the stock price. What is this information? For suppose company's quarterly financial results are good, then what happens? Stock price will increase, yes or no? Stock price will, obviously what happens? Stock price will increase. Here the point is, the stock price reflects, I mean already the stock price has taken into consideration what? Publicly available information, then that is called semi-strong. That is called what? Semi-strong. So now come to this question. Which of the following statement defines an efficient market? Information is fully reflected in stock price. In a weekly efficient market, the stock price reflects the past price and traded volume. In the strong form of efficiency, all information, including insider information, is reflected in price. 32 question. This is also June 25 question. 32. Okay, the answer is 1.0628. I am not going to explain now, because the reason is in suggested answer they have given A, B, C and D. Okay, because the answer is not correct. The question itself is not framed properly. So last time I took half an hour time. I paused the video. Okay, and I have tried a lot to justify this 1.0628. But that fellow gave 4 answers, A, B, C, D. Unnecessarily I wasted half an hour time. Okay, so the answer is what? 1.0628. Okay, 33. This concept, frequently asked concept, 33. The expected return from a portfolio is, in last 4 attempts, 3 times this concept was asked. The expected return from the portfolio is 16%. Expected return 16. In June 25 also this concept tested. Expected return 16. Variance of a return 285. Investor tolerance 60. Investor's tolerance is what? 60. So this formula you have to note it down. Risk penalty will be risk penalty. Risk penalty will be risk penalty. And also what? Risk utility. Risk utility. So see, once 285 divided by 60. What is this 285 divided by 60? 4.75. So risk penalty is equal to variance divided by investors tolerance. Risk penalty variance divided by what? Investors tolerance. Risk utility is equal to expected return minus risk penalty. Expected return minus what? Risk penalty. So what is expected return? 16 minus risk penalty 4.75. So in this question only they are asking what risk penalty. What is the risk penalty? 4.75. Next 34. In 100 days stochastic analysis. So this is a completely new question. Completely new. I have already told you out of 15. So 2 MCQs will be what? Completely out of the way. So December 24 MCQ. In 100 days stochastic analysis, the closing price is 160.5. 100 days low and high prices 145.2, 190. Stochastic percentage is equal to current close minus current close. What is the current closing price? 160.5 minus low divided by high minus low. into 100. 34 point current closing minus low divided by high minus low. So note down the formula. Stochastic percentage is equal to what? Current close minus lowest low divided by highest high minus lowest low. So answer is 34.15%. Which one of the following is not a part of market risk? Downgrade risk is not a part of market risk. 36 risk utility. Expected return of P is 15%. Expected return P. Variance 280. Investor tolerance 70. So risk penalty is equal to 280 divided by 70. 4. Risk utility. Investors utility is equal to. Investors utility means satisfaction. What is the expected return? 15. Minus risk penalty 4. 11%. Investors utility is equal to 11%. Clear? So with this we have completed what portfolio management MCQs, multiple choice questions. So total 5 MCQs are asked from this 36. Okay. Again for December 25 also same MCQs. I might add 2 or 3 MCQs, that's it. If they are important, after analyzing, if I feel important, I will be adding what? 2 or 3, that's it. So for 2 or 3 MCQs, do not wait. You practice these MCQs, okay? If required, I will do, okay, the video again, I mean additional MCQs. Clear? So with this we completed what? Portfolio management. Clear? Pramada, she is encouraging me. Thank you. Online students, is it clear? Done? So portfolio management, the live duration 5 hours 41 minutes. YouTube live duration 5 hours 41 minutes. Okay, but in between, whenever I asked you to try the question, then I have paused the video. The duration of the video is 3 hours 54. So some editing has to be done. Okay, sometimes I forgot to pause the video. So 3 hours 30 minutes. 3 hours 30 minutes, okay. So whenever you start revision again, you can watch this video, okay. Clear? Varsha? Online students, is it clear? Bangartalli? Vaishnavi, Vinila? So tomorrow our topic is what? Derivative analysis, okay. Until you sleep, recall what? Portfolio management formulas, questions, special points, etc. etc. Clear? Tomorrow our class timings will be 2 p.m. Tomorrow our class will start at 2 p.m. Okay. I will do something. I will ask my boss to reduce duration to 2 hours. Law class. Is it clear? Please share your feedback in comment section. Mention your place. Okay. Thank you all. Thank you so much. ఈరోజు ప్రాక్టీస్ చేస్తారా? అది టెలిగ్రామ్ గ్రూప్లో షేర్ చేశాను ఆల్రెడీ. టెలిగ్రామ్ గ్రూప్లో ఉంది. ఇప్పుడు ప్రయారిటీ బేస్లో MCQs సాల్వ్ చేయండి. ఆ MCQsలో కూడా ఏంటిది అన్నీ చేయక్కర్లా, వాటిల్లో కూడా ఇప్పుడు మార్క్ చేసుకోండి ఏది A+. కొన్ని ఏమో ఈజీగా ఉన్నాయి. RP - RF డివైడ్ బై సిగ్మా P. ఆ ఊరికి చేయడం వల్ల టైం వేస్ట్, అవునా కదా. కొన్ని రిపిటేటివ్ ఉన్నాయి. ఓకే, కొన్ని చూసుకొని మీరేంటి ప్రాక్టీస్ చేయాల్సిన 2 3 ఉన్నట్టున్నాయి, అంతేనా? 3 4 ఉన్నట్టున్నాయి. అది ఇప్పుడే చూస్తే మీకు అర్థం అవుద్ది.